Okay, it's time to start. Welcome to this webinar hosted by the Bank of Finland and SUERF, the European Money and Finance Forum. I am Esa Jokivuolle, Head of Research at the Bank of Finland. Bank of Finland has a long and successful history in organizing joint conferences with SUERF. Last time we met in the fall 2019 in Helsinki. This time we are online, but I am confident that after 2 years, when we meet again, it will be in person. This year's topic is Monetary Policy Approaches, a Comparative Appraisal. The program looks great, and I very much look forward to the presentations. I would already now like to thank all the presenters for kindly agreeing to contribute to this event. Unfortunately, my colleague from SUERF President Professor Jakob de Haan cannot join us now. He has connection problems, but he sent his best and would like to welcome you also on behalf of SUERF. We now have the pleasure to hear an opening address by the Governor of the Bank of Finland, Olli Rehn, who is also a member of the ECB Governing Council. Governor Rehn, please, the floor is yours.
Thank you, Esa. Ladies and gentlemen, dear friends, good afternoon and virtually welcome to this conference to sunny Helsinki, to this conference on monetary policy approaches, a comparative appraisal, which is, as Esa said, jointly organized by the Bank of Finland and the European Money and Finance Forum, SUERF. Our collaboration with SUERF in organizing biennial conferences has a long and successful history for which we are indeed very grateful. I wish to extend my thanks to all those colleagues and friends who have contributed to making today's conference possible. We are honored to have some of the leading experts in the field to address us at this conference, including the panelists Philip Lane, Andrew Lewin and Patricia C. Mosser. The organizing committee have done an excellent job in putting together a high-quality program for us today. In my opening remarks, I will discuss monetary policy in the emerging post-pandemic context as seen from the perspective of the euro area, especially from the northernmost member of the euro area. Let me first make a few remarks on growth and inflation outlook and then discuss the recent strategy review of the European Central Bank and its conclusions and implications. The euro area economy has rebounded significantly this year on the back of the reopening of the economy and strengthened policy support. According to the ECB's September staff projections, real GDP is projected to grow by 5% this year, 4.6% next year, and around 2% in 2023. Not surprisingly, we have seen some inflation peaks in the recent months on both sides of the Atlantic and globally. And last week in the IMF annual meetings, one is bound to witness an intensive debate on back to the 1970s stagflation and whether the recent rise in consumer price inflation is of transitory or permanent nature. Let me give you my take on this. We have a saying in the European Union, nothing is more permanent than something called transitory. By experience, this is often true, but I have to say it is somewhat more complicated this time around. As you know, the debate is particularly heated in the US. However, in Europe, there is still plenty of slack, and Europe is in another phase of recovery and behind the economic cycle compared to the United States. Yes, we have seen some inflation peaks in Europe as well. Last month, consumer price inflation rose to 3.4%. Annual inflation is forecast to reach an average of 2.2% this year, supported by temporary factors such as strong base effects caused by the rapid rise in energy prices, especially electricity and gas, and the cost pressures arising from more persistent shortages of materials and equipment than previously thought. In 2022, i.e. next year, inflation is projected to moderate to 1.7%, as the factors now deemed temporary should start to fade away, and is projected to stay at 1.5% in 2023. In my view, euro area inflation is still mostly transitory, even if some of its components are partly more persistent than previously expected. However, we must recognize that the micro experience of the ordinary people is quite different from the macro reading of the economists and central bankers. If this state of elevated inflation were to last much longer, it would likely have a more significant effect on inflation expectations. Indeed, the selling price expectations 3 months forward of both industrial and retail sectors have started to rise amid these temporary price pressures. Moreover, the short-term inflation expectations derived from the market information, that is inflation swaps, has increased to 1.8–1.9%. However, the counter-evidence speaking for the transitory interpretation is quite convincing. When looking at the longer-term inflation expectations, there is no upward trend. The probability distributions of market inflation expectations have strongly concentrated between the levels of 1.5 to 2.5%, and the probability of inflation higher than 2.5% is very small indeed. Core inflation in the euro area is still subdued, and the latest reading being 1.7%, and it is projected to stay at 1.5% in the medium term. So far, there is no major evidence of second-round effects through wages. Wage growth is still below the pre-COVID average, despite significant sectoral labor shortages. So we may ask, where does the euro area stand when facing the classical monetary policy dilemma of not overreacting to the supply-side shocks on one hand, and engineering a reduction of stimulus without de-anchoring inflation expectations on the other hand? When answering this question, we should do so against the backdrop of the ECB's new monetary policy strategy, which is built on a symmetric 2% inflation target and on a reaction function that tolerates temporary overshooting. As core inflation is at 1.5% in the medium term, and the latest reading of long-term inflation expectations, five-year was at 1.9%, we may conclude that the trend in euro area inflation is now in line with the ECB's revised strategy. Logically, on the basis of this data and in line with its new strategy, the ECB leans on the side of not overreacting. Dear friends, let me now turn more specifically to our strategy review, which was concluded in July, a few months ago. High-quality analysis and extensive dialogue between research and policy making were crucial for reaching substantive, pertinent conclusions going forward. You may compare the strategy review exercise to a major research project with dozens of in-depth seminars covering key issue areas that are relevant to the making of monetary policy. We reviewed the definition of price stability, monetary policy instruments and their effectiveness, as well as our communication practices. We also assessed the importance of digitalization, financial stability, globalization, monetary and fiscal policy interactions, and climate change from the perspective of monetary policy. The most important revision to our strategy is the new definition of price stability and the reaction function, i.e. how it will be applied in our future decision making. According to the new strategy, price stability is best maintained by aiming at a 2% symmetric inflation target over the medium term. The old aim of below but close to 2% was less precise, rather ambiguous and very much open to interpretation. In particular, the former definition had probably a certain feel of asymmetry, and its ambiguous wording appeared more of a ceiling than a symmetric central target. The new 2% inflation target is genuinely symmetric, unambiguous and easy to communicate. Symmetry means that the Governing Council considers both slower and faster inflation to be equally undesirable. The symmetric 2% inflation target under the new strategy thus serves as a buffer against deflationary risks and provides monetary policy with more space to react to a sharp decline in inflation. Obviously, we also want to rein in the costs to the economy from a too high rate of inflation, and we have the tools to do it effectively if and when needed. This change in the price stability definition is clearly reflected in our forward guidance. As decided at our monetary policy meeting in September, the Governing Council expects the key ECB interest rates to remain at their present or lower levels until it sees inflation reaching 2% durably, and until it judges that the progress realized in underlying inflation is consistent with inflation stabilizing at 2% over the medium term. Commitment to a symmetric inflation target requires particularly strong or long-term monetary policy measures when interest rates are close to the zero effective lower bound. This commitment, which is buttressed by the new forward guidance, is crucial to support the anchoring of long-term inflation expectations to 2%. But as said, it may also imply a transitory period in which inflation is moderately above the target. A medium-term orientation for the inflation target is baked into the new strategy, which also makes it possible, where necessary, to smooth out other economic shocks, such as shocks related to employment or financial stability. If actual inflation is slower or faster than targeted, monetary policy will respond to deviations gradually, considering the nature of the economic disruption. Deviations estimated to be temporary may not be responded at all, but seen through. The symmetric inflation target should help to ensure a stable and predictable price outlook, which is a key prerequisite for sustainable economic growth and a higher level of employment. Price stability, balanced growth and a high employment rate are mutually consistent goals, and successful monetary policy improves the well-being of citizens by focusing on price stability. To this end, targeted monetary policy communication can improve people's understanding of how monetary policy responds to current and projected economic conditions. The Ecb Strategy review also examined how monetary and fiscal policy can work together during and after times of crisis. The conventional thinking gives a clear division of labor between the monetary and fiscal authorities. Monetary policy should promote price stability, while fiscal policy should keep sovereign debt on a sustainable path. However, in a period of low interest rates, the scope for monetary fiscal policy interactions is possibly wider. Countercyclical fiscal measures complement monetary policy when key policy interest rates cannot fall any further. Similarly, low interest rates can keep financing conditions favorable during and after crisis, thus creating space for fiscal authorities to respond to an economic downturn and hence stabilize the economy. Fiscal policy also matters for the transmission of monetary policy in low interest rate environments. A recent study by Nigel McClung of Bank of Finland, the power of forward guidance and the fiscal theory of the price level, argues that fiscal support is essential for forward guidance announcement to have the right kind of effect on inflation and output. Fiscal support remains important at the effective lower bound and before inflation robustly converges to the 2% target. Moreover, in that context, structural reforms are needed to support labor supply and also productivity growth. Then there is the Voldemort or the threat of fiscal dominance, a scenario in which monetary policy is linked to the sustainability of public debt. Fiscal dominance scenarios are associated with high inflation and volatile macroeconomic conditions, that could ultimately lead to loss of central bank independence. Such scenarios are certainly not desirable. It is clear that the ECB Governing Council has the mandate, the will and the tools to counter and prevent such scenario. Moreover, the fiscal framework should be such that it first of all ensures debt sustainability while being sufficiently flexible to allow macro stabilization, especially when the economy is at the effective lower bound. And that is why fiscal rules are of major relevance for monetary policy as well. Even though the existing EU fiscal rules have been criticized and the criticism is to some extent justified, discarding the rules without a clear alternative would obviously be a major mistake. We should not throw the baby with the bathwater. Once the rules are reformed, what should the reform look like? In my view, the rules should be made simple and transparent, like our new definition of price stability on the side of monetary policy. Clarity supports the effectiveness of rules and it also enhances accountability, which is of paramount importance, like national ownership as well. One good starting point is the proposal by the European Fiscal Board. This proposal includes an expenditure rule which could be defined so that it effectively limits expenditure growth also during economic upswings. There is evidence that broadly this kind of expenditure rules, perhaps complemented with other fiscal rules, have been successfully applied in many countries. And they have successfully helped to ensure medium-term, long-term debt sustainability. Regarding the design of the rules in general, it is important that they are based as much as possible on observables and not on unobservables such as output gap and potential output. That's why an expenditure rule is clearly a preferred method of ensuring debt sustainability compared to, say, structural deficits and very complicated rules. Last but not least, there is the issue of climate change. While governments and parliaments have the primary responsibility for climate policy, the ECB, within its mandate, also needs to support these objectives. Among other things, the ECB will expand its analytical capacity to incorporate climate issues in its economic models and to promote the measurement and disclosure of risks related to climate change. By thus expanding its analytical capacity, the ECB can effectively account for climate issues in its risk management analysis, investment activities, and monetary policy operations. So, ladies and gentlemen, dear friends, a warm welcome once more on behalf of the Bank of Finland and the other organizers. I wish you all a productive and enlightening conference. But before get going with the first session, if we have time, let me open the floor for possible questions. Thank you very much for your attention.
We may still wait for a while if questions are posted in the chat. So please use the chat function to make questions. Klaus, Adam, if you can join online, so please go ahead.
I have a question regarding, can you hear me? Sorry.
Yes, very well. Please go ahead.
Yes. So looking forward on, following the strategy review, to what extent do you think, or are you confident that the new symmetric 2% goal will actually be reached with the current policy framework? Because you have decided against not incorporating any make-up strategies to your policy path. And while you sort of tolerate a temporary overshoot in bringing medium-term inflation back to 2%, you do not target such overshoots in any systematic way. And the question that then arises is to what extent you will actually be able to reach on average a 2% target, or whether or not you might still fall short of that and stay effectively again close to but below the 2% target.
Thank you, Klaus, very much for your very pertinent question indeed. This issue was obviously very intensively discussed in the process of preparing the strategy review and preparing the conclusions of the strategy review, and we concluded, as you implied, we concluded with two major cornerstones for the strategy. First of all, with the symmetric 2% target over the medium term, and secondly, with a reaction function that may imply a temporary period of overshooting. How does this work, and what kind of development do we see in inflation and inflation expectations today and going forward? As I said in my opening remarks, we have seen a certain rise in both consumer price inflation and more importantly in inflation expectations going forward, both in fact in short-term and long-term inflation expectations. I usually tend to look at core inflation first of all, because that is clearly the parameter that is important for medium-term inflation outlook and thus for monetary policy. Core inflation, which as you know is neutralized from the volatile price swings of energy and food prices, is still rather subdued, but we are seeing some rise in that in the short term. At the same time, we have seen a certain rise in inflation expectations, and the long-term inflation expectations 5 year over 5 year have risen to the latest I saw. I checked 2 days ago was 1.9%, I think 1.88%. So what this shows is that at least we are avoiding the scenario of Japanification that we were worried some time ago, and we are out of the deflation danger zone, and the trend is now in line with the Ecb strategy and towards our symmetric 2% inflation target, with the caveat that this may imply temporary overshooting as well. So it means basically not overreacting to supply shocks in the short term, and having accommodated monetary policy stance low for longer. So the difference between the Fed definition and the ECB definition is sometimes in the eye of the observer. What I mean is that the Fed defined as Chair Powell put it in August last year at Jackson Hole. The Fed is practicing a flexible form of average inflation targeting. We have a symmetric 2% target, and our reaction function may imply a transitory period of overshooting that target. Thank you.
Thank you. And then there's a question by Piet Christiansen. With the markets also being driven by Bank of England and Fed repricing, do you worry about markets not fully understanding your reaction function or sequence of rate hike or asset purchase program net end?
Thank you, Pete, for this very important question. I do worry. I always worry about communication, and especially whether our communication is understood and preferably understood correctly. So this means that we have, as always, we have a challenge to communicate our reaction function. But in my view, it is today quite well understood by market participants and the ordinary people who are interested in matters of monetary policy. And this is very clearly spelled out in our latest monetary policy statement in September. Next time we will discuss this in our regular meeting, which will take place next week in Frankfurt, and we will then communicate. President Christine Lagarde will communicate, I trust, as always, very clearly concerning what our forward guidance implies for rates and asset purchase programs. But yes, it is a continuous challenge, and in the current context of plenty of movements and changes in both the economy and policy, it is of particular importance that we communicate very clearly so that our message is correctly understood. And in this regard, forward guidance is a very important monetary policy instrument.
Thank you. It seems to me that there are no further questions. There is one more coming from Juha Broderus. What is your view on the market pricing and that of survey measures such as SPF, that inflation will remain below the ECB's 2% inflation target in the medium to long term? Are you satisfied with the current inflation expectations?
Thank you, Johanna. This is an issue, or the issue which I always look at very carefully when I get the data from Chief Economist Philip Lane and the ECB staff in front of my eyes on the table at Frankfurt. And as you may know, and as you have seen often, we have both market-based data and survey-based data in the same chart, and without not underestimating the importance of market participants and their opinions, I look more to the information of market data, because in some ways that is if not hard but harder data than the soft data of surveys. In a way, the market data reveals the real actions, while survey data may imply also tactical voting, and at least it is more, of course, an opinion survey than say reliable hard data. So yes, the survey data is important, but I find the market-based data, still more relevant for our policy consideration, for our consideration of policy making. And as you are asking if I'm satisfied with the current inflation expectations, so I think as a general philosophy, it's dangerous to be satisfied or unsatisfied of inflation expectations. They are data for me, and I take it rather neutrally and try to see what kind of ways we may have to influence them so that they anchor to the right level, at the right level. Having said that, it is a fact that both short-term and long-term inflation expectations have risen in recent weeks and months, especially compared to the outbreak of the COVID pandemic and the subsequent sharp economic downturn. We have now clearly higher inflation expectations that are actually getting closer to our inflation target. And as I responded to Klaus Adam previously, we are converging towards our target, and our new reaction function implies that means that this may also imply a temporary period of overshooting. So to sum up, we look at both CPI or the HICP, consumer price inflation. We look in particular core inflation, which is neutralized from energy and food prices, and we look at inflation expectations, and on the basis of this and some other factors, we judge whether we are on the way towards our inflation target, in line with our mandate to ensure price stability. Thank you very much, and I wish everybody indeed a productive and enjoyable conference, and hope to see you next time physically in sunny Helsinki. Thank you very much.
Thank you very much, Governor Rehn, for your opening address and taking the questions. And now I give the floor to Juha Kilponen from the Bank of Finland to chair the first session. Juha is the head of monetary policy and research in the Bank of Finland. Juha, please.
Thank you. Good afternoon indeed from quite sunny and still colorful Helsinki. Olli Rehn's introductory remarks already addressed many topical questions in monetary policy, and he provided us some insights on the Eurosystem's monetary policy strategy review. It is my pleasure now to act as the chairman of the first research-oriented session, which is entitled as Unconventional Approaches, in the brackets. And we have today in this session 3 very experienced researchers presenting their findings related to various but still interrelated topics on monetary policy. We will start with Klaus Adam. I can see he's ready already there, who is a professor from the University of Mannheim. And he will address us on the topic central bank objectives, targets and tools, and provide some hint on what is the optimal target for inflation. Looking very much forward to that discussion. The second presentation is by Oreste Tristani. He's a senior advisor from the European Central Bank, and he will discuss what monetary policy can, should, or perhaps should not do about financial stability. And finally, we have Ludwig Straub, assistant professor from Harvard University. He's presenting his and his co-authors' work on indebted demand and its implications to monetary policy. His paper goes in the heart of very important question for monetary policy and central banks. What explains declining natural rate of interest and what implications that has on monetary policy? Now, on practical details, each presenter has 30 minutes, so you are in a spotlight for 30 minutes, and this time includes the questions from the audience, and possibly also from other session participants. And now, please, those that are in the audience, use the chat function in Teams to pose your questions online. I will then read them after the presentation and give the floor then to the presenter to reply. With that, Klaus, you are now on the spotlight for 30 minutes.
Okay, so thanks very much, Juha. It's a pleasure being here. So I suppose slides are upcoming. Okay, so let's move right away to the next slide. It's a great pleasure being able to talk about this. Obviously, it's a broad topic I was assigned, so I will draw on two underlying papers. One is the CEPR review on the ECB Strategy review that I've written with Lucrezia Reichling and a number of other co-authors. And the second paper I'll draw on is a working paper that makes the case for a positive euro area inflation target, and that is written with co-authors from the Euro system, Avant Gauthier, Sergio Santoro, and Henning Weber, and of course, nothing I say implicates them or the institutions where they work at. So let's move to the next slide, please. So I think what has happened with the recent rise in inflation is that price stability has come, again, as a policy objective to the forefront. Can we see the next slide, please? Okay, thank you. So this is after a long time where inflation was sort of there but dormant, and during the time of dormant inflation, central banks have really ventured in terms of adopting a range of additional policy objectives. Some of them have been there before, like financial stability has been there, certainly at the macro level. But now, in particular in the Euro system, we have now also micro financial stability in terms of bank supervision residing at the central banks. We have also other objectives like the broad objectives that are assigned by the treaty also to the ECB, a balanced real economy, etc. Some central banks, like the ones in the United States, have even included distributional tasks like inclusive growth that would include employment of certain disadvantaged groups in society, etc. And finally, as Governor Rehn mentioned, we also have climate change targets now included in central bank policy. So can we move to the next slide? So now, somewhat, surprising is the fact that all these new tasks have, by and large, being adopted during a period in which there was a persistent shortfall with regard to the primary objective. So it seems a little bit like, central banks didn't know what to do really to achieve their primary objective and kept on venturing into other fields and adding these objectives. And also, it was a period in which, policy as such was constrained along many fronts. So it's very surprising that when you're constrained by the lower bound, maybe by issuer and capital key limits in the purchase programs, that we start on adding these new things. This is just an observation. It's not a judgment that it was wrong to add these additional targets, but it's a surprising feature. And this is particularly surprising because these added targets came in a period in which really few additional and particularly effective new policy instruments were added to the toolkit of central banks. Certainly, there was the bank supervision that moved to the central banks and therefore were allowed to address the micro financial stability issues at banks. But at the macro financial importance, we don't have much, okay? We have perhaps the macro pro measures, but we don't know how effective they are. And for all the other things, we haven't gotten anything new at the time of, on the side of central banks. So can we move to next slide, please? So, and in light of this, we find that it is even more surprising that the ECB strategy review, if you read the 18-page document that has been released that sort of summarizes, synthesizes what the review has achieved, there is this sort of pretense that, with all these new objectives and very few additional tools, there somehow still is no trade-off between price stability and this other objective. So if you read the document, you read that financial stability is a precondition for price stability. Price stability is a precondition for financial stability. A balanced real economy goes along with price stability. We can achieve climate targets without affecting price stability. And this is perhaps a very convenient position if you want to avoid questions about how your primary mandate relates to other things you want to pursue. But it is not perhaps very helpful because some of the trade-offs going to come perhaps apparent very soon. So suppose, for instance, we would have a more forceful and a more persistent upswing in inflation, which I don't think is likely, but it's certainly something that can happen. And the ECB would need to start taper its asset purchases going forward. And soon, with the conditions we have in some of the government bond markets, trade-offs could emerge between price stability on the one hand and financial stability on the other hand. And in this regard, we find, the authors of the report that I just mentioned on the first page, is that the new ECB strategy provides very little guidance on how these trade-offs are sort of going to be handled. And in particular, it also provides no framework that allows to, conveniently communicate about the alternative goals and how they sort of interact in decision making. So this is an observation, and I want to stop it at this point. In the report, we actually make a proposal of how it would be possible to incorporate additional policy goals into a setting where price stability is still the primary mandate. And I encourage you to read about our proposal, but it's certainly not something that is currently enshrined in ECB strategy. Okay, so then let's move to the next page, please. So with regard to the primary objective of central bank, there are, of course, many very welcome changes in the ECB strategy. Governor Rehn mentioned these: the symmetric inflation target, a commitment to a forceful reaction to deflationary shocks, and the willingness to tolerate temporary overshoots in bringing medium-term inflation back to target. But there are also some things which remain unaddressed in our view. So let's move on to the next page. One is that there is really no quantitative analysis that is underpinning the chosen numerical value for the price stability objective 2%. So the argumentation that we find in the review is something like that. We start from a baseline of 0%, okay, strict price stability, which, by the way, happens to be optimal in many of the monetary policy models used at the ECB or in the Euro system. And then we add to that baseline number for a number of forces that, Governor Rehn also mentioned. For instance, we want to avoid at the country level deflation in a heterogeneous monetary union. So let's add a little bit to avoid such kind of situations. Perhaps we want to correct for inflation mismeasurement because of unaccounted quality progress that is reflected in inflation. So let's add a little bit that. Let's add a little bit to get policy space, because we have the lower bound constraint somewhere there and also low real interest rates. So what we have done in our research is we have, that is the second paper I mentioned, is we have, sought to challenge this notion that the optimal inflation rate is 0. Okay, so the baseline from which you then add all these other concerns. Okay, and so the remaining talk, what I want to do is talk about, the challenge of this baseline number of 0. Okay, so can we move to the next slide? So I will explain to you in intuitive terms where this 0 benchmark comes from in the standard monetary models and in the standard discussion, monetary theory, then explain why this benchmark empirically makes little sense, and then convince you, after you've seen some evidence on that, that the benchmark should perhaps be higher and somewhere in the range of perhaps 1.5%. Okay, so if we start adding concerns like lower bound concerns and so on, we shouldn't start at the 0 level, we should start at somewhat higher level. Okay, that of course also means then that maybe some of the concerns like the lower bound are then less strong if you start with a higher level, but it is certainly, seems not very plausible to start with this 0 benchmark. Okay, so let's move into the argument why 0 is optimal. So if you have a number of products, okay, like 1 and 2, and their relative prices should be constant, okay, so this is 2 lines over time, prices are constant, relative prices are constant, and they are efficient. It's a great idea not to have any inflation, because if you had inflation, then these lines couldn't be flat, but they had to move up, and that's shown on the next slide, okay? If you had inflation in the presence where relative prices need to be constant, both prices would need to be trending upwards over time. Okay, and that is not a good idea in a setting where prices don't move flexibly, as there's a lot of evidence that they don't do, and where the adjustment of these prices doesn't happen in a perfect synchronized way. So if this were the efficient prices, okay, but the adjustment is sort of lumpy and infrequent, then what would happen is shown on the next slide, okay? We would have infrequent, lumpy adjustments. Could you please show the next slide? Okay, so instead of having the blue lines, which sort of keeps prices at their efficient relative level, we would have these infrequent, lumpy adjustments. And as a result of that, prices get distorted. Okay, and this is because there is inflation. Okay, and as a result of these price distortions, we're going to see quantity distortions and misallocations in the economy. And therefore, it is optimal not to have any positive amount of inflation, but to have 0 inflation. The argument is perfectly symmetric for why we then don't want also deflation, because similar things like in this graph would happen if we had deflation. Okay, so that is basically where the 0% optimality comes from in all the monetary policy models. So let's now move on to the next slide and I want to explain to you why this benchmark makes, in empirical terms, little sense. Okay, and the reason is that this benchmark assumes that relative prices are constant over time. And this is something that happens, just not to be true in actual economies. So can we move to the next slide? Okay, so the world looks different. In particular, there are relative price trends everywhere. In particular, we have documented extensively, and I'm going to show to you that newly incoming products, okay, that come newly into the market, initially tend to be expensive relative to the competitors, okay, a narrowly defined set of competing products. And then as the products age, their relative price falls, okay, and this is a pervasive feature of modern economies, and I'm going to show you data from France, Germany, and Italy that is there equally the case. And the question is, what would be then the optimal inflation rate in such a setting? And I've drawn a little picture for you in the next slide that will illustrate the situation. So this is a situation that is having constant product entry and exit. Constant product entry, products enter at a high price, then their relative price falls over time, and then they exit at a low price. Okay, as I will show you, this is the average pattern in the economy. Okay, obviously the degree at which relative prices falls will vary across different product categories, different goods versus services, etc., and within the goods category across different goods. But this is the pattern that they generally display. Now, if we had the average price constant, in this economy. Okay, so if we were to move to a situation with zero inflation, then each and every product, in order to have this relative decline in the product price, would have to adjust its price. So we get exactly the kind of distortions that we would get, that I showed you we would get with zero inflation and with non-zero inflation in the other example. So can we move to the next slide? So in this situation where we target zero inflations, but where it's efficient that prices decline over time, you could get this lumpy adjustment of prices as a result. Relative prices are distorted, and we're going to get misallocations in the economy as a result of that. So what is it that we could do? Well, this is shown on the next slide. Okay, instead of having the relative price decline because each and every individual product cuts its price over the life cycle, we keep the product price of each and every product constant, but let successive products, as they enter over time, charge higher prices. Okay, and this is shown on this graph. So each product keeps, in this idealized situation, the price constant over time, but successive products charge higher prices so that the average price increases and the relative price now falls because the average price increases. Okay, this is efficient because now no product in this idealized situation needs to adjust the price ever. Okay, and what is the efficient rate of price increase to have in order to get at this? Well, it's the inverse of the relative price decline that you want to implement. Okay, so now let's move to the next slide. So with this in mind, okay, you can estimate the efficient rate of inflation by estimating the efficient rates of relative price declines, okay? And we show how we can do that using microprice data from France, Germany, and Italy. In particular, what we're going to use is the microprice data underlying the construction of the consumer price indices, the harmonized consumer price indices in these countries. And we have 10 years of data, around 100 million price quotes, and we can compute or estimate for each product and expenditure category, what is the rate at which relative prices decline at the product level, okay? And that is actually going to be the efficient rate of price decline for reasons I have no time to get into, okay? And then we're going to get a distribution of relative price declines, and the inverse of that would be the distribution of optimal inflation rates. And that's what I'm going to show you on the next slide. Okay, so this is the distribution of the optimal inflation rates in France, Germany, and Italy, okay? And it gives you the rate on the x-axis, and on the vertical axis, it gives you the importance of these products, the expenditure share. So look, for instance, at France, okay? You see a lot of the products don't display, a lot of price trends. There's some bunching around zero, okay? There's quite a number of products that do not display trends in relative prices. But then there is a tail to the right that says some of the products have rates of relative price decline of 3, 4, or even more than 5% per year. That means the products become cheaper at a rate of 5% per year, okay? And there is some small tail to the left, but it's much less pronounced, okay? And that already tells you that on average across all products, there's going to be, an optimal rate of inflation because the rate of relative price decline is positive, okay? Germany looks very similar to France. There's a little bit more mass in the negative part. I'm going to argue why that is. And Italy looks a little bit different because things are more concentrated around zero than in the other two economies. Okay, so let's now move on to the next slide, which explains us how these sort of optimal rates of price decline can be combined to get an optimal inflation number. Okay, so let's move on. Okay, so we then use these sort of estimates as an input into a standard sticky price model that allows us to compute the optimal aggregate inflation rate in the presence of heterogeneity in the efficient rates of relative price decline. And things, after long derivation, things turn out very simple. The optimal inflation rate that you should target on average, the steady state inflation rate, is just a weighted average where the weights are the expenditure weights of the product, okay? And each of these products enters with the efficient rate of relative price decline, okay? So if you have a 2% efficient relative price decline, that would suggest 2% is what this product then contributes to the optimal inflation number, okay? This is a first order optimal, the first order approximation to a nonlinear result. We have also nonlinear result. Things would then look more complicated, but it's something that happens, that holds independent of the precise details of the pricing frictions. You could have time-dependent frictions, many-cost frictions, etc. Okay, so what we're now going to show you is I'm going to take these rates of efficient price declines B, going to aggregate them with the expenditure weight, and I'm going to give you a number pi star for each of these three economies that is optimal in order, that is the new benchmark instead of the zero. Okay, and let's just move on to the next slide then. Okay, so this is what we get just from price stickiness alone, okay, by aggregating these rates of price decline with the expenditure weights. We get, close to but below 2% for France and Germany. And then in Italy, we get a slightly lower number of 0.8%, because in Italy, the right tail of that, optimal inflation distribution was less pronounced. If we aggregate these three economies according to their consumption shares to a synthetic sort of euro area, it's only 65-66% of the euro area, then we get a number of 1.5%, and that is the number I've mentioned to you. So this is very far in, when it comes to the purpose of monetary policy from the zero inflation benchmark that is routinely used. Okay, so let's move now a little bit to the next slide and look a little bit more deeper at what kind of products, contribute to these positive rates of inflation. Let's have a look at Germany, for instance. In Germany, let's look at all three goods. Okay, the column on the left gives you the country, and then it gives you the inflation rate that is optimal for certain subcategories. So the first one is food. There isn't much going on. Okay, not a lot of relative price declines. Probably you're familiar from that from, supermarkets, etc. Things don't contribute there. The rightmost column gives you the contribution from services, okay? Equally important expenditure category. There's not much there, except in Germany, there is this evidence that as services age, they become slightly more expensive. So relative prices increase, and that contributes a little bit to contributing to a negative optimal rate of inflation. Okay, and then the middle column gives you, where the most action is. It is in the non-energy industrial goods. It's in the goods sector. Okay, relative prices there decline at the pace of close to 5% for France and Germany, and perhaps half that, 2.5% in Italy. Okay, where could this come from? Well, it could be, efficient trends could come from learning by doing effects and things like that. Okay, so this is where really all the action comes from. Okay, let's move on then to the next slide. Now the question is, okay, suppose now, like in the first column here, the optimal inflation rate is 1.5%, which was our benchmark estimate, okay? What would happen if instead you targeted an inflation rate of 0, okay? We have a closed form result that gives us the welfare consumption equivalent welfare losses in present value terms, okay? And they turn out to be very large, okay? Several percentage points of consumption in present value terms, and that just suggests to you that targeting an inflation rate of 0 would, be a very strong error. Would be a strong policy error, even absent any shocks or lower bound concerns. Okay, so now let me conclude and then move on to the questions. I've argued two things. First, central banks pursue a broader set of objectives, but without a broader set of instruments. So they should, explain to us how they want to handle the trade-offs, and also communicate, perhaps, in terms of these trade-offs, if they want to pursue these additional goals. And then, with respect to the primary objective, I argued that, our thinking shouldn't start from a benchmark rate of 0 as being optimal, but perhaps from a rate that is somewhat higher due to the presence of relative price trends. And the empirical evidence for France, Germany, and Italy suggests that this rate is somewhere in the neighborhood of 1.5% in the euro area. Thank you.
for this very interesting presentation. We have time for some questions, and there's already 3 questions from the same person. So let me start from the first one. So I read you the question. Do you think that the ECB's tools are still functioning properly in the current economic environment, which shows signs of stagflation?
Okay, so well, I think I think there's of course some concern as to whether, there was some concern as to whether the quantitative easing tools, besides affecting just the long-term interest rates, were also effective in stimulating demand and bringing inflation up. But this sort of, discussion seems a little bit gone, because now there is somewhat more upward pressure, and we are perhaps more worried about a potential situation where we want to rein in inflation, and I think the tools for doing that are certainly there.
Then there's another question. It's actually related to the first part of your presentation generally on the objectives of the central banks. So most young people think that the central bank should play a more active role in solving social problems and giving increasing importance to climate change. And he wants to know which is the best strategy to ensure the compliance of the treaty's objectives in terms of climate change, as well as the mandate for achieving price stability. Not an easy one.
Yeah. Well, the treaty has a clear hierarchy in the way it assigns tasks to central banks. Certainly, I mean, climate change is a huge societal challenge, and of the of the European Union, and therefore ECB will have to contribute its part to the extent it can. But I frankly speaking, I think what the ECB can do is overall, by and large, going to be fairly limited, because the tools that are necessary and that need to be deployed to fight climate change reside squarely on the fiscal side, and it is there where the main action has to come. And of course, the treaty, could be changed in future iterations to sort of bind future fiscal authorities in sort of achieving more firmly those goals that have more than, often than not been missed in the past.
Thank you, Adam. And it was Mikel Lareina who was asking these very good questions. There are still a few more. So let me read another one. This is from Ulf Söderström, which you, Adam, know very well. Klaus, you know very well. So presumably, different sectors have different degrees of price stickiness, and then should get different weights in the optimal inflation rate. Do you take this into account?
Yes, that's an excellent question. We have, this is not a first order effect. So heterogeneity in price stickiness doesn't generate first order effects on the optimal rate of inflation, unlike heterogeneity in the optimal in the efficient rates of price decline that do generate the first order effects. So this would be higher order effects, and we have looked into this. So if you want to see an analysis of this, you can have a look at our UK paper. The thing is just that, where we get closed form solutions for these sort of higher order terms are the Calvo price setting models, and these do not necessarily make very stable and reliable predictions on what will happen to markups and price dispersion as you deviate from the optimal inflation rate. So we have actually not a lot of confidence in those sort of results, and therefore our baseline results do not take into account heterogeneity in price stickiness. But that's a very good question. Yeah.
Thank you, Klaus, and thank you, Ulf, for this good question. I can see there's at least 2 more questions, and maybe we can take another 2 minutes or so. There's a long question from Ernst Gnan, who will be the chairman of the next session. So let me try to read it for you. At the start of your presentation, you raised the issue of how to cope with potential risk of financial dominance in an environment of rising inflation, when tightening the stance might trigger financial instability. Of course, financial stability side effects of monetary policy are also evident during expansionary phases. Now comes the question, what is your recipe how to cope with this side effect, avoiding both financial crisis and financial dominance?
Yeah, I mean, ideally, yeah, that's a broad question. I'm not sure I'm going to have time to fully answer, but I mean, it is important that the ECB signals to the fiscal side that it is not responsible for, keeping government finances in check, and that is something that resides with the fiscal authorities, and that they cannot count on the ECB to achieve that. I think that is an important thing to signal. And to the extent that is credible, it will work and will be anticipated. But of course, it is a game of chicken between both sides, and it's a very difficult one to resolve. And because, as Governor Rehn said, then maybe transitorily it want to smooth the transition to a regime that would allow to deal with a potential default situation, and then it may end up being a permanent one. Yeah.
Thank you. There are still a few questions there. What I suggest to do is maybe we copy them, and then later on can send you Klaus directly, and you may answer these persons directly if you want so. I don't want to take more time from the other presenters, so thanks a lot, Klaus, for interesting start of the session and for the questions as well. So then we move on to next presentation by Oreste Tristani from the European Central Bank. Oreste, the floor is yours.
Thank you, Juha. Can you confirm that you hear me well?
Yes, we do. And the slides are there.
Okay, so let me start by thanking you and the organizers for having me here. This is from the program. It sounds like a very interesting conference, and Klaus was confirmed this perception with this initial talk. Now, my assignment here is to talk about something a bit narrower, so the relationship between monetary policy and financial stability. I must say I'm old enough to know that this is a recurrent theme in monetary policy, in the monetary policy debate. And so let me say that, especially for those of you who are also not too young, that I'm not going to give you revolutionary new perspectives on this topic. What I'm going to do is to summarize very briefly the many analyses that were included in the Eurosystem staff material prepared for the Governing Council in its review of this topic in the context of the monetary policy strategy. And all this analysis is collected in an ECB occasional paper, which is mentioned at the bottom of this slide. It's on the role of financial stability considerations in monetary policy and the interactions with macroprudential policy in the euro area. Now, we normally start these presentations by acknowledging all the co-authors, but in this case, it would take me half of my allotted time to do so. So let me refer you to the occasional paper also for the full list of contributors. I only want to underline here that all the co-authors belong to all national central banks of the Eurosystem, not just the ECB, and that the occasional paper attempts to represent in a balanced way all these various perspectives. So can we go to the next slide, please? So having said that, so since we have relatively little time, I would like to focus in particular on two aspects. The occasional paper discusses financial stability from 4 different angles. It looks at the legal perspective, it looks at it more theoretically, and then empirically, and finally in terms of practical implementations. In the presentation, I will skip a lot of this discussion. I will focus on the 2 questions in this slide. So what is the economic case for monetary policy to also be concerned about financial stability? And then what this could mean in practice for the ECB. Okay, so next slide, please. And I will start from the first question. So indeed, the next slide. So the answer to this question, to answer this question in the occasional paper, we find it useful to start from the notion of the financial cycle. So this refers to the alternation of periods of booms and periods of crisis. So booms are periods characterized by the buildup of systemic risk. So increases in indebtedness, increases in asset prices, and crises are periods where systemic risk suddenly materializes. Okay, in the end, so the reason why we think that this notion is useful is that it is ultimately a reminder that crises do not happen by chance. They're not just a result of bad luck. They have their root causes, and those causes can be addressed before they produce their disruptive effects, or at least they can be tamed. And it's exactly this recognition that after the financial crisis led to the introduction of macroprudential policy. Now, macroprudential policy instruments have been designed specifically to address these root causes of the financial cycle. They can be targeted, and the idea is that they should be used in a counter-cyclical fashion, so they should be tightened in the upturn of the cycle to limit leveraging and asset growth, and they should be released in a crisis to prevent excessive deleveraging. So thanks to this institutional development, so macroprudential policy clearly is what is referred to in the first line here, the first line of defense against the buildup of financial imbalances. And I should say the monetary policy, macroprudential policy is especially useful in the monetary union, because if financial cycles are not synchronized across countries, which is often the case, then macroprudential policy tools targeting country-specific developments will be more effective and also more appropriate compared to area-wide measures. So I'm emphasizing this point because it is important to take into account this development when asking the question, when asking what is the case for monetary policy to also react to the financial cycle. And indeed, one could take the perspective that with macroprudential policy in place, there is nothing else to do. And this type of perspective is sometimes cast in terms of the so-called Tinbergen principle, which state that there should be ideally a one-to-one mapping between instruments and objectives. And so macroprudential policy with its instruments should focus on preserving financial stability, and monetary policy should focus on price stability. And that will be the end of the story. Now, strictly speaking, the world is also changing. Monetary policy that no longer has a single monetary policy instrument. There are many unconventional monetary policy measures that have been implemented. But more generally, or from a broader perspective, the Tinbergen principle is only valid in an ideal situation when there are no spillovers between the policy instruments in the two domains and the objectives of the others. So let me discuss this further. Please, next slide, please. So the occasional paper argues first that instead these spillovers are pervasive. And ultimately, this has to do with the fact that monetary policy and macroprudential policy have many transmission channels in common. So monetary policy decisions aimed at maintaining price stability will normally have or play some effect as well for the prospects for financial instability and vice versa. So just an obvious example, to give you an obvious example in the current situation, one of the concerns that are often voiced is that the expansionary monetary policy stance of the ECB, which aims to reestablish price stability over the medium term, may also produce adverse effects on the financial sector, in particular on the banking sector. So there are also other, this is the example I just gave you refers to a negative spillovers, but the occasional paper also emphasizes many instances of positive spillovers, and these are also occurring very often, and actually they probably prevail over the longer term. I don't want to go into the details here because we don't have much time. But I just want to underline that these are also present. But going back to the short-run trade-off, this, or if you wish, side effects, the question is, so these ones also then must play a role in the determination of the two policies. And from the perspective of monetary policy, the question is whether monetary policy specifically is producing some side effects through the policy of low interest rates. Next slide, please. So in the debate, there are two specific examples of potential side effects of this low interest rate policy. And let me just focus on one here. This is on the profitability of financial institutions. So just as an illustration, the figure in this slide shows the distribution of bank interest rates on their retail deposits. And these are retail deposits on non-financial corporations since 2014. And this is the period when the deposit rate, the rate on the ECB deposit facility declined below, it turned negative. And what this figure shows is that the interquartile range of the retail deposit rates is the sort of thicker box in the figure, has tended to bunch up around zero, but has not become negative itself. And so since many short-term rates in the markets and returns are currently negative, from this perspective, this source of funding for banks, retail deposit rates, is only available at above market rates and is therefore creating adverse effects on the profitability of banks. And also these adverse effects are likely or can be expected to increase over time to the extent that the returns on assets also remained low or did not increase. Now, it goes without saying that there's identifying adverse effects of low interest rates on the financial sector is not the same as identifying adverse effect of monetary policy on the financial sector. And in fact, low interest rates are partly the response to adverse cyclical factors, and partly also due to cyclical reasons. There is as you know, and we will also hear some later, a literature on the determinants of the so-called low natural interest rate. So in this situation, the economic stimulus, which is imparted by low rates, has actually had positive effects on the economy. By sustaining the cycle, it also sustained the economic cycle. It also sustained credit growth, and it has indirectly also benefited profitability in this way. So the overall impact on monetary policy on the financial cycle from this perspective, or at least on the profitability of the financial sector, may also have been positive. Okay, but nevertheless, the point here is to emphasize that the impact of low interest rates and the low interest rate environment on profitability can be a source of concern. And there is at least a theoretical possibility of what Markus Brunnermeier and Jakob have called a reversal rate. So the possibility that at some point interest rate cuts may be contractionary beyond a certain sufficiently low level of interest rates. So next slide, please, and the next one. Let's keep this one, please, for lack of time. Next slide, please. So which type of conclusions do we draw then? So ultimately, the simple conclusion drawn in the occasional paper is that this consideration implies that, so again, the existence of these spillovers between monetary policy and financial stability create, at least conceptually, a case for monetary policy to take financial stability into account. Okay, in this case, you can also see as being reinforced, of course, if the macroprudential framework is not fully developed. So what does this imply in theory? In theory, and there are now many frameworks that make this very concrete from the theoretical perspective, conceptually, when systemic risk is not being tamed by macroprudential policy or not being tamed enough, and ceteris paribus, then the monetary policy stance should act symmetrically, and it should lean against the wind when systemic risk builds up, and it should be looser when systemic risk is realized. So this is what is often also called cleaning in the literature. So far so good for the theory, but in practice, defining precisely, what is systemic risk, quantifying what it means to have a bit tighter or a bit looser policy, assessing quantitatively the benefits of leaning against the wind in a model which can be considered to be broadly realistic. All of these things are hard, and they require explicitly dealing with nonlinearities and validating them also on the data. And while, again, we do have available nonlinear frameworks to analyze these topics, and others are being developed, they're still typically stylized, and therefore it is difficult to use them to draw very clear quantitative conclusions. Now, the occasional paper makes a few attempts to go in these directions. I don't want to pick on any specific result here because there is little time, and I don't want to, and also for diplomatic reason, I don't want to pick an author compared to another, but of a particular model compared to another. But the results essentially are along the lines of indeed suggesting that there are cases in which this type of symmetric approach is beneficial. There can often be even complementarities between price stability and financial stability through this type of approach. But at the same time, if there are cases of trade-offs, we don't have always very sort of clear normative guidance from these perspectives. So what to do in practice? In fact, in practice, we also look at the practices of other central banks, and cleaning after a financial crisis is in general a policy which receives broad support, because financial crises are often accompanied by deflationary pressures, and so acting aggressively, at least in the short term, with the policy easing, monetary policy easing to maintain price stability after the crisis will also typically be beneficial for financial stability. Leaning against the wind instead is more controversial, and this just to summarize the usual, very again long-standing debate. Its advantage is that it gets into all the cracks of the financial systems, and so regardless also of the regulatory perimeter. But its cost is that a monetary policy tool can be too blunt, in the sense that in acting against the risk of financial instability, it can create excessive cost in terms of the economic activity. So not surprisingly, once we also look at the experience of other central banks, the application of a systematic leaning against the wind approach is rare, and in some cases it has proved to be problematic. Okay, next slide, please. So what does this all leave us with for the perspective of the ECB? And the occasional paper here reviews two main options. Can I ask two main options for the ECB? The first one is to implement a formal leaning against the wind through a flexible implementation of the ECB's medium-term horizon. And the second one is a more pragmatic option. So let me quickly wrap up by summarizing them in turn. Next slide, please. So what about the medium-term orientation? So the ECB has always had this medium-term orientation to pursue its objective of price stability, and this objective has been confirmed with the strategy review. The medium-term orientation is partly there to allow for inevitable short-term deviations of inflation from target. But more generally, it also takes into account that the appropriate monetary policy response to shocks may change depending on the nature of the shocks and on their persistence. So for those of you in the literature, think about the response to cost push shocks. Now, as such, and I think just as a quick reference to what Klaus mentioned before, one idea of the medium term is also to allow for these secondary objectives, and which in the strategy statement are referred to as other considerations, using more of a legal language rather than the typical one that economists use. So an obvious option at this point, so given the existence of the medium term, an obvious option is to take into account financial stability risks through the medium term. So there can be a flexible adjustment of the medium term, used for this perspective. So suppose, for example, that financial stability risks were detected in a phase in which inflation is returning slowly to target from below. Then the medium-term the medium-term horizon should be extended to some extent, and so monetary policy would be a bit tighter than it would be otherwise, in order to reduce this likelihood of a financial crisis down the line. And this would imply a somewhat longer, more prolonged period of deviations from price stability before inflation reaches again 2%. Again, the occasional paper attempts to evaluate this type of policy quantitatively, and the extension. And one issue that he finds is that the extension of the horizon that may be necessary in the example that I gave can be very long, and this creates implementation challenges if this horizon went beyond to very many years. Then the medium term will become void of content from a practical perspective. Maybe more worrisomely, the persistent inflation deviation from price stability may also generate a disanchoring on inflation expectations if some expectations are not formed fully rationally. And if this were the case, the cost of increasing of a tighter monetary policy on economic activity would increase substantially. And so from this perspective, this policy would also be problematic, and this even before even taking into account all the difficulties to assess financial stability risks in real time and in a confident manner. So next slide, please. So with this consideration, so the paper does not conclude in favor of this sort of medium-term adjustment, but it suggests instead a more pragmatic approach, which is what is referred to there as an enhancement of the role of financial stability analysis in monetary policy. So here, pragmatic means that there will be no commitment to responding to specific indicators or to in a predefined way and subject to well-defined contingencies. And it ultimately means paying attention to financial stability more systematically in monetary policy deliberations. And now let me immediately stress here that it's not the case that monetary policy decision-making did not take financial stability consideration into account before. Of course, so it did. But the idea is here to enhance this type of analysis and make it more systematic in the way that it is presented to the governing councils. So this would imply, first of all, sort of looking deeper into the longer-term build-up of vulnerabilities, the ones that have ultimately could have consequences for output and inflation once a crisis were to occur. And essentially, this implies extending the scope for this analysis beyond the traditionally monetary policy horizon and looking also further towards the horizon when the possible financial crisis could occur. And a second point is that subjects to identifying risks for financial stability, this enhanced analysis should also systematically assess whether risks are partly the side effects of monetary policy. And in that case, there may be implications, for example, in terms of recalibration of the combined set of standard and non-standard monetary policy measures, which in a way has to minimize those side effects. And the second, an additional perspective to take in this analysis would be to also assess more systematically whether there are planned or already implemented macroprudential measures that are sufficient to address the financial stability concerns, and therefore, from this perspective, any concerns for monetary policy could be assuaged. Now, operationally, the occasional paper recommends having this enhanced analysis as part of the monetary policy making process. And for example, this would imply having presentations at regularly monetary policy meetings, as also done for other presentations. And even if this presentation may not necessarily occur at a high frequency because the development in financial stability risks move more slowly. And since I am from DG Research, let me also conclude by emphasizing that all this analysis, in order to be convincing from a quantitative perspective, it also requires a substantial research effort to develop the quantitative tools that we need. And these tools are really important, also in particular in view of these difficulties in the practical implementation of linear against the wind type policies. But they're also necessary also to make these notions very precise, starting from the notion itself of financial stability. So I'm not sure, but I think I have exhausted my time. So maybe I can just leave you with leaving up the last slide. The next slide, please, which simply summarizes again what I mentioned. We said that there is a conceptual case for monetary policy to take financial stability into account. The medium term, adjusting the medium term in a flexible way may be an imperfect way to do so. The occasional paper suggests or recommends a more pragmatic approach. And as I said again, this will require a sustained research effort to develop suitable models and tools. Thank you.
Thank you, Oreste, for dealing this very difficult but interesting topic that we face in central banks almost daily. I don't see any questions in the chat at the moment, but please, if you have any, put there. I wanted to actually pick up one question from your, I think it was the last slide in the concluding slide. You mentioned that there's a importance to enhance, say, our toolkit when it comes to analyzing financial stability issues and monetary policy and their interaction. So we did a lot of work in this part of the strategy review on this topic. I wanted to ask from you that where do you see the sort of key analytical gaps when it comes to analyzing the interaction between monetary policy and financial stability? What would you like to have in your toolkit when you go and advise the policymakers on this topic?
Yeah, so from, desiderata are always good to list, but let me just, just give an example just for concreteness. I mean, one question in this field is that we are almost forced to sort of move beyond the linearized world, which we have, developed extensively for monetary policy analysis. I think that this is a good thing, but again, in this case, it is necessary. And unfortunately, once we go beyond this linearized world, then we have many more challenges, not only in terms of, or should immediately having to use more complicated solution methods in order to see what the model implies. But we also get another order of model implications that need to be sort of tested against the data, and before we can be confident in what the model is suggesting, in certain situations can be confidently, taken as realistic. So I think that we have already some models along these lines. I mean, let me just advertise one of the papers developed at the ECB by Alejandro van der Gote, who has a very simple model to analyze this combined work on monetary policy and macroprudential policy. There is also ongoing work in this area. So Jordi Galli has a new paper with a former colleague of mine, Frédéric Boisset, and other co-authors, and all this analysis, I think, are very useful in this context per se. But I think again we need to have more validation of their implications to be able to then draw some confident conclusions and policy advice.
Thank you, Oreste. There's now a question in the chat, so let me read it for you. This is from Mikael Juselius. First, thanks for interesting presentation. he has one comment. The division of labor between macro-pru and monetary policy also rests on the assumption that the different macroprudential tools are effective. This may not always be the case. This can be an alternative motive for monetary policy to take financial stability concerns into account in addition to spillovers. And you alluded to this possibility with the gets into all cracks argument. Now he would like to ask you if the report that you referred to or built your presentation, if the report consider the effectiveness of different macro tools.
Thank you. So, yes, there is a discussion in the report specifically of the effectiveness and the limitations of macroprudential tools. So this is okay. I'm not sure whether you hear me. I can see that there are connection issues, maybe. But okay, I'll go ahead, assuming that it's okay. So this is definitely an issue, in particular in the euro area, because the architecture of macroprudential policy is extremely sort of complex. There are some macroprudential tools that are available, that are centralized, other macroprudential tools that instead are available at the country level. And of course, coordination even within the macroprudential realm is a challenge, and so it's completely true that the limitations of macroprudential policies certainly an argument for monetary policy to also take financial stability into account. Now, of course, one could also use these potential limitations as simply an argument to strengthen macroprudential policy and argue that it should indeed be made more effective to the extent it is not already. And in so doing, one would also achieve better outcomes for sure, because, as I said, it is the first line of defense, and I think there is broad agreement about this.
Thank you. There is two more questions, and I'm going to read you one more, and then it's a very good question. In fact, it's from Klaus Masuch. Thanks a lot for the great presentation. In terms of sequencing, would you agree with the view that in current situation, with robust demand, inflation moving higher and rather high asset price levels, macro should ideally move preemptively and before monetary policy to strengthen the resilience of the financial sector in a view of the risk of possible increases in loan losses and asset price declines associated with higher future interest rates? That goes in the core of your presentation.
Klaus, it's very interesting from Klaus. I think the paper, the occasional paper, sort of purposefully stays away from any discussion of the current situation. This was the overall mandate in the monetary policy strategy review. It is not about today, but this is about a framework that should be useful for the foreseeable future. So let me just not answer that question, and I'm sure Klaus can answer that question himself as well. So but I think that from the modeling perspective, we don't have complete clarity. So certainly, if there are risks on either side, it is typically the case that they should be addressed preemptively. But as far as I can see the literature, there are no clear sort of priorities that one can generally assign to one policy or the other.
Thank you, Oreste. And with that, in order to stay more or less on time, we are a little bit late, but still, I would like to give now floor to Ludwig from Harvard University. The floor is yours.
Thank you very much, Juha. I hope you can all hear me. Perfect. Well, thank you very much for inviting me to speak at today's conference. I obviously would have loved to be in Helsinki with you all, but and then I wouldn't have to get up so early. But nevertheless, I'm very excited to be here and present some recent work that I have done joined with Atif, Mian, and Amr Sufi. The presentation today is called Indebted Demand and Implications for Monetary Policy, and it will mainly focus on a paper that it has, a similar title that is joined with the two of them. I'm gonna give you a more conceptual presentation, but I will touch upon some of the more empirical recent findings that we have documented in other work as well. Great, so on the next slide, please. Great, so I would like to motivate this presentation with the following two plots. On the left, you see US household and government debt relative to GDP. And those types of debt we think of as sort of financing the demand side of the economy, and that's why we're grouping them together here. On the right, you see several measures of real rates of return, for example, real mortgage rates or the real return on wealth in the US. And you see that sort of taking both together, that at the same time as debt levels doubled, interest rates have come down quite significantly. Now, as you all know, this is not US specific. This looks similar in a lot of advanced economies around the world. And so the standard story for accounting for these trends is that a reduction in interest rates for whatever exogenous reason made debt more affordable, and that caused sort of an increase in debt levels over the past 2 decades. And what I would like to do today is propose a complementary story that sort of goes the other way around, from high debt levels to low interest rates, and then also study the interaction between both of these stories. Next slide, please. So how does this story work? So when debt levels are high, all else equal, debt service payments are high. And when borrowers have a greater MPC out of those debt service payments than savers, this will, all else equal, reduce aggregate demand and push down the natural rate of interest, R star. And that's the story that can get you from high debt levels to lower interest rates. And then obviously that would lead to amplification, because lower interest rates then make it more affordable to take up more debt. Now, this mechanism rests on one key assumption, namely that savers have a lower MPC out of debt service payments compared to borrowers. And next slide, please. And in recent work of ours, we have found some suggestive evidence that this assumption is indeed correct. So that's not super trivial to do, because we need to know who are the savers and who are the borrowers. The borrowers are typically easier to find, easier to characterize. For example, if you look across the income and wealth distribution, you see that the borrowers are typically located in the bottom 90%. And for savers, what we have done is we have sort of tried to trace back ownership of debt as an asset through the US financial accounts. And on the left-hand side, you see that if we do that and then attribute these holdings across the income or wealth distribution, we see that typically what you find is that the top 10%, sort of the more rich, Americans, as well as the rest of the world, are owners of government or household debt. And so you see that that's sort of the group that we can think of as savers. And on the right-hand side, you see that those people are also the people that we think of or we find to have higher saving rates than the rest of the population. And so that gives suggestive evidence that there is actually a difference in saving behavior between savers and borrowers, and that underlines that there might be this MPC difference that I mentioned. Great. On the next slide, please. So how do we incorporate this into a framework, into what we're going to call the indebted demand framework? So in the paper, we write down a microfounded stylized model that matches the key features. In particular, the model is going to have rich savers and poor borrowers, and the savers are going to have a higher saving rate, and that's generated by non-homothetic preferences. Now, the main insight you get out of this model, out of this framework, is that increased debt levels give rise to an increased resource flow from borrowers to savers in the form of debt service payments, and that then reduces aggregate demand due to this MPC difference, and hence reduces R star, the natural rate of interest. I'm going to talk in the following about a number of important implications this has on, for example, how on the effects of recent trends in inequality and financial deregulation, as well as for monetary policy and certain kinds of fiscal policies, such as redistribution. And I'm going to focus today in my presentation mainly on sort of a graphical analysis of this framework, rather than going through all the details of the model. Perfect. So next slide, please. So I will explain the framework in terms of a diagram, and that diagram will always have the interest rate on the y-axis and the level of debt on the x-axis. And there's two curves in this diagram, and they sort of loosely correspond to supply and demand. So there's that demand condition, the blue line, that captures that the demand for debt by borrowers slopes down in the interest rate. So lower interest rate correspond to greater debt levels. That can be because, say, house prices are higher and so collateral constraints more relaxed, or because just debt is more affordable. Now the supply condition, the red line, captures the interest rate that is necessary to finance a given level of debt. And here, greater debt levels in our framework mean greater debt service flows from high to low MPC agents, and hence aggregate demand and our star are going to be lower with higher debt levels. Now, next slide, please. If we did not have any heterogeneity in the MPC out of debt service flows in our framework, notice that the supply condition would be just a flat line, because then increased debt levels would not entail any kind of effect on aggregate demand or R star. Great. So let's go to the next slide. So what does this framework deliver? So the very first, very simple thing you can do here is you can increase inequality as sort of an exogenous way to redistribute resources between those two agents, in this case from borrowers towards savers. Now, what does this do in our framework? So it shifts the supply condition to the bottom left. So why is that? Because for any level of debt, now more resources going to savers means that there's going to, on average, be an upward shift in savings pressure, and that will reduce the natural rate of interest. But notice that here, this actually sets in motion a feedback loop, right? With lower interest rates, debt becomes more affordable, and collateral constraints relax because, say, for example, house prices increase. And that leads to then more debt being taken out by borrowers, which then leads to greater debt service flows, which mean even more resource redistribution in the long run from borrowers to savers, and so on and so forth. So at the end of the day, we see that inequality in this framework, increased inequality, predicts a significant reduction in the natural rate of interest and significant increases in debt levels. And so if you take a step back, obviously this is in line with the results I mentioned in the beginning. And sort of the broad implication here is that inequality should be related to wealth accumulation. And this is something that we have gotten back to in recent work, and in fact, some of that work we're still developing. So on the next slide. So here on the left, you see a simple scatter plot at the national level for the US, linking the top 1% income share on the x-axis to the aggregate wealth to income ratio on the y-axis. Now you see that there's a pretty tight relationship here, but this is obviously just based on time series variation, and a lot of that can be driven by other factors that are unrelated to the sort of more causal link that we would be interested in. So one, the ideal thing that we would want to have is that we have different places and we have sort of we feed in random trends and inequality and see that whether inequality is related to wealth accumulation or not in that kind of a setting. Obviously, we don't have that anywhere, but we can get a bit closer to that ideal by looking across subnational units in the US, namely states. So here on the right, you see a scatter plot that has on the x-axis the the change, the long difference in the top 1% income share within states, and the long difference in the wealth to income ratio within states. And basically what you see is that there's still a very tight relationship here, and this one even holds if you account for other factors that affected states, such as migration or demographic trends. Perfect. Next slide, please. So now let's consider a second set of implications of this framework, and namely for financial deregulation. So financial deregulation in this framework can be thought of as sort of an outward shift in the demand condition in the blue line, right? So for a given interest rate, it means that more can be borrowed. Think of, say, a relaxed LTV constraint. Now, as you can see from this diagram, this will in general result in a reduction in R star in the long run. We go from the left intersection, the left sort of steady state, to the right intersection, the right steady state. And what is very interesting in this experiment, however, is that it's not just that R star falls in the long run, but in the short run, it actually rises. And you can sort of, graphically see this in the black line. It increases first and then falls. So why is that? So on the next slide, I explain the intuition for why this is the case. And in fact, what is happening here is that financial deregulation induces a boom-bust pattern in the economy. So initially, there's a boom phase. Credit expands, demand increases, and R star increases. And why is that? Because there's a resource flow on net from savers to borrowers in this episode in the form of new credit growth, right? Say the collateral constraint relaxes, borrowers take out more debt, and that causes, on average, for resources to flow from savers to borrowers. Later on, however, and even without any reversal in financial deregulation, just because credit growth naturally slows as, say, borrowers take advantage of those new funding opportunities, approach, say, their new borrowing limit, the resource flow will reverse its direction. So why is that? Because, as new credit growth stalls, debt service flows start to increase because now there's a larger stock of debt to be financed. And so in that case, we enter a bust phase where aggregate demand starts falling and R star starts falling as well. Perfect. Now let's go to the next slide, where I then want to turn to monetary policy. So how can we think of monetary policy in this framework? Imagine we begin in this intersection, in this, say, steady state of the economy, and then we consider monetary easing. Now, with a lower interest rate, we sort of drop down along the dotted line. Debt starts expanding, so we start moving to the right. Now, in the short run, this increased debt might be appreciated by policymakers because it helps generate demand. However, in the longer run, increased debt levels mean that R star is actually coming down as debt levels start rising more. And so in that case, whenever the central bank would like to fade out its monetary stimulus, it has to remain accommodated for longer because R star has come down during its stimulus, or it risks throwing the economy into recession. And I think this is a kind of an interesting departure from Milton Friedman's natural rate hypothesis, which contended that R star more or less moves exogenously, and monetary policy only needs to track the natural rate without having to think about the effect it has on the path of the natural rate itself. And through this lens, one implication might be that maybe the US hiking cycle that they embarked on that the Fed embarked on in sort of 2004, 2005 may have actually been too fast and may have actually contributed to the reduction in demand that followed during the financial crisis afterwards, right? Maybe the interest rate that was set by the Fed maybe sort of overshot R star in that episode. Perfect. Next slide, please. Now, once debt is sufficiently high, R star may be so low that the economy is at the zero lower bound and hence in a liquidity trap. Now, because it's associated with high debt levels, we call such a liquidity trap a debt trap. Now, such a debt trap is not easy to resolve. For example, you might think, oh, because it's associated with high debt levels, why don't we use macroprudential policies to sort of rein in debt? And the problem with that is that that will limit aggregate demand. And in a place where aggregate demand is short to begin with, this will only worsen a recession. So that's not a sort of painless tool to get rid of the debt trap. Now, our framework instead suggests that it might be better to treat sort of the underlying causes for why debt came to be so high in the first place. For example, treat things like inequality. Now, there's many ways to do this, and I don't want to get into any debate on which is the right tool. But one way would be, for example, to redistribute. Another one would be, say, to have a more progressive tax system. Now, let me also highlight here, especially when talking to people inside the euro area, that obviously these lessons do not only apply within countries, right? One plausible reinterpretation of this framework is that savers correspond to sort of saver countries within a currency area, and borrowers correspond to debtor countries. And in that case, we can have flows between savers and borrowers that capture the cycles that I talked about. And we can have that, redistribution is one of the answers to sort of secular declines in natural interest rates in the currency union. Great. On the next slide, I'm going to conclude. I have tried to explain a key concept that we have developed in work of ours, namely that of indebted demand. So what is that concept? It's the idea that demand is connected to debt service payments by borrowers. In particular, the demand falls when these flows, the debt service payments, are high. Now, this implies, as I argued, that rising inequality causes lower natural interest rates and higher debt levels, that financial deregulation can cause boom-bust episodes, and that monetary policy is not independent of R star, and in fact has some effects on R star, and that breaks the natural rate hypothesis. Well, thank you very much for your attention. I'm looking forward to the questions.
Thank you very much, Ludwig, for these somewhat unconventional views also on determinant of R star and what's the role of monetary policy driving something that we're used to think as exogenous part. Again, the floor is open for questions, and I don't know if also the other session participants would like to address questions directly to Ludwig. I pause for a second here, and I already see Klaus raising his hand. So Klaus, go ahead.
Yeah, hi Ludwig. Yeah, thanks a lot. So I'd have a question. So if you increase the wealth share of the low MPC people, and that is driving down the natural rate, wouldn't that also imply that you sort of would see an investment boom simultaneously with that? And couldn't that be something good for the economy, because now the capital accumulation somehow must be higher? Or is that not I mean, it's not something we really have seen during this low R star period, but wouldn't a model that have capital generate that?
That's a fantastic question. I agree with you that pretty much any neoclassical model of investment predicts that when the interest rate is low, investment should be high. Now, this is, I think, a challenge to almost all stories that explain R star. And that's, in our research, we have pointed that out, that this is, I think, one of the open questions of our time. I don't think it's so related to sort of our story for why R star is low, rather than sort of a critique of a broader literature. There have been some attempts to explain why investment has been rather weak. So for example, some stories rely on falling growth rates, and that's why investment has been weak. Others rely on increased markups and firms therefore being sort of unwilling to invest so that their MPK equals the interest rate. My own personal view is that we're not quite there at sort of quantitatively understanding the entire sort of sluggishness of investment. So I do consider that a very, very open question still, but one that I hope that we're going to answer in the next couple of years. But I agree with you. I think that's a challenge that we really should think about more.
Thank you for this answer and the question. There is one more question now from Esa Jokivuolle. I read it for you. Would you characterize the case here that there is a market failure or externality that policy should aim to correct for?
Great. Yeah, so I think the cleanest case for this can be made at the zero lower bound or close to the zero lower bound, right? So if the natural rate moves down closer to zero, even if it doesn't, cross zero, then there's a clear sort of aggregate demand externality that becomes more relevant, right? Because ZLB-induced crises might become more frequent the closer we are to the ZLB. And so I think that's a clear source of an externality that policymakers should think about. Now, is the right tool to just keep interest rates away from the zero lower bound artificially, despite our star being sort of close to it? No, right? That's not going to be the optimal answer in our model, because that would just sort of induce a recession where one maybe wasn't necessary to be introduced. So there's other tools that then have to be used to do that, and I've already mentioned one of them, namely that we think about sort of the underlying causes. We think about whether it's inequality what's driving things or other factors, and try to attack the problem in that way.
Thank you for this. I actually would have one question by myself. So you emphasized a lot of the role of increasing inequality of explaining the declining R-star. I mean, to some extent, the interest rates are, say, globally determined. And I mean, you could make an argument then that counteracting the rising income inequality would require a concerted approach from the different governments. And well, it may be quite unlikely outcome. So in the light of this, one could ask that are we destined to stay with low R-star for a very long time?
That's a great question. I think all else equal, the reality is probably that it is hard to attack this problem without a sort of a simultaneous or similar push in a sort of larger part of the advanced economy world. Now, to be fair, obviously the US itself, for example, is a large player in that advanced economy world. So similar the Euro area. And so if there are tendencies in these places to, for more inclusive growth, for example, then, and I think that's kind of what we're seeing at least right now, then that could play a role in increasing natural interest rates in sort of the medium term. So I can see that maybe not because of some concerted action, but maybe because of correlated factors that drive this sentiment in different countries. I could see that is something that is underway right now, but we'll have to see how it plays out over the next couple of years.
Thank you very much. I think it's time for us to conclude, and finish this session. So I just want to thank presenters, Klaus, Oreste, and Ludwig for very good presentation and very lively session in general in terms of very good questions also. We have now a lunch break until 14:15 Central European Time. So about 1 hour, we are only 5 minutes late of time. Now, but before you run for lunch, I would like to note that during the lunch break, you are welcome to follow the virtual poster session chaired by our head of research, Esa Jokivuolle. And this poster session will focus on what we can learn from policymakers' intentions and preferences by analyzing their communication. There will be 2 papers presented, one from the Bank of Finland and one from the Austrian Central Bank and Vienna University of Economics and Business Vienna researchers. So you are welcome to follow the poster session, and we will reconvene then 14:15 Central European Time. Thank you very much. Bye-bye.
Okay, thank you very much, Juha, and welcome to the poster session that takes place during the lunch. So you have the opportunity to not only nourish yourself with food, but also to have food for thought also during the lunch hour. And so we are about 5 minutes plus late with our schedule. That's not much, but I'd like to ask the presenters to maybe cut just a few minutes, if possible, from their presentation time to also allow for some time for questions. And in the spirit of a poster session, so please also post clarifying questions in the chat already during the presentations, if there are any, and I can even try to make them directly to the presenters if needed. So let's start with the paper by Palovita, Haavio, Jalasjoki, Kilponen, and Vanni, 5 co-authors. Markus Haavio is the one presenting, and the paper is on, they're all from the Bank of Finland, and the paper is on reading between the lines, using text analysis to estimate the loss function of the ECB. Markus, I hope you're ready online. The floor is yours. I can see Markus' picture, but Markus is still muted. The microphone should be on, I think. Voidaanko tarkistaa, olisiko puheyhteyttä tähän Kiljaniin? Okay, so If we have the presenter of the second paper, Kilian, reader ready, we could take Kilian, you first, and then continue with Markus later. Kilian, can you hear me? And
sure, we can do that.
Okay, so let's do that. So let's start with Kilian's presentation. So this is joint paper with Philip Nahn, and the paper is about who talks during monetary policy quiet periods and why, evidence from the Europe. So now we have both Markus and Kilian. Let's continue with Kilian now, and then take Markus as the second.
Mulla on ihan normaali tapaus, että se on niin kuin joka toinen esitys on aina tällainen.
Can we mute Markus? Okay, Markus is muted, so now we can give the floor to Kilian, please.
All right, so hello everyone, I hope you can hear me and you can also see the slides. Thank you for including our paper in the program. This is joint work with Philip, who is based at WU in Vienna. And since I'm in central banking, the usual disclaimer applies to this presentation. So I should also say thank you for joining us, and I hope you're enjoying your lunch at the moment. So if you follow prominent central bank watchers on Twitter, you may have already encountered their remarks about the non-compliance of central bankers with the so-called monetary policy quiet period. You can find these remarks literally for all major central banks, including the Bank of England, the ECB, and the Fed. And that's basically what we show here on this slide. And these remarks are certainly not a recent phenomenon. Now, what exactly is the quiet period and why do we think that it is important? So the quiet period essentially represents a self-disciplining rule book, if you will, in place at all major central banks. And this kind of rule book regulates public statements by decision makers in the days prior to monetary policy meetings. During this quiet period, usually statements on the future monetary policy stance and economic developments are not allowed or forbidden. And the main idea behind having this kind of quiet period is to prevent strategic communication that locks in policy options by shaping market expectations, and also to reduce market volatility in the run-up to meetings. But if you think about it, the quiet period is essentially, of course, a double-edged sword. On the one hand, it reduces the amount of overall statements just before policy meetings, but on the other hand, it makes individual non-compliance by individual policymakers particularly powerful, and some policymakers might actually exploit this. So the question that we are trying to answer in this paper, at least a little bit, is why and when central bankers breach the quiet period. So far, empirical evidence on this question has proven relatively elusive because there are a couple of reasons for that. First, because systematic data is hard to get by on statements during the quiet period. Second, because consistently classifying statements into breaches or non-breaches is difficult and arguably also, of course, subjective. And third, because specific types of policymakers might obviously select into speaking much more than others. So we have a selection bias issue as well. What we try to do in this paper is to fill this gap a little bit in the literature by drawing on the case of the European Central Bank. And we try to do this by exploiting a new data source, an ECB proprietary data set, namely internal summaries by the ECB's Directorate General Communications. What happens to these summaries is, in these summaries, is that they essentially classify public statements by governing council members during the quiet period into breaches and non-breaches of quiet period rules. And they do so before each monetary policy meeting in a consistent way since 2008. If you look at these summaries, you will find that the breaches are defined as statements on the future monetary policy stance and economic developments, whereas non-breaches are defined as statements which essentially decline to comment on these two topics, or which do not refer to these topics at all. So what we have from these internal summaries is basically for each statement since 2008, the name of the governing council member speaking, the statement itself, the dates, and the news source as well. Now, we use this data essentially to provide the following 4 types or sets of contributions. First, we provide a sort of first descriptive statistics on the evolution of quiet period communication and breaches since 2008. And second, we attempt to identify systematic patterns in breaching behavior by relating these statements to a list of member statements and statement-specific characteristics. Third, what we also try to do is to understand the ECB's internal classification scheme. And fourth, we also exploit exogenous variation in the voting rights on the governing council to explore whether there's any sort of evidence for strategic communication during the quiet period. Now, let me start by giving you a little bit more details on what the quiet period is in the Eurozone and how it looks like. So it was first introduced in 2001, and it covers the 7 days before each monetary policy meeting. But systematic monitoring of adherence to the quiet period rules only started with the Trichet presidency in 2003. The issue is, however, that the summaries of statements that we use as our source only has a consistent format since the fall of 2008, and that's why our sample starts then. In the case of the ECB, and that's perhaps the last important point to note, is that there are no formal sanctions for breaching behavior. But what happens is that the summaries get circulated about among governing council members, and there's some informal admonishing or shaming going on when the council meeting takes place. At least that's what we think from the outside. Now, to produce our final data set, we actually match the statement level data from the summaries with information on the members who are speaking, including age, education, length of service, etc. And we also match these statements with national macro data for the member sending countries like inflation, unemployment, and other standard variables. What we also do is to better understand the ECB series, so the ECB series of breaches, we also conduct a statement-by-statement review of the ECB's classification for all the more than 900 statements that we have in our data set. And what this review essentially provides us with is an alternative series of breaches, which we can then compare to the original series by the ECB. Of course, we document the reasons for each possible reclassification in the data appendix to the paper. Now, this is a slide that summarizes our data in a single graph. It basically shows the total number of quiet periods and how quiet periods breaches and how they evolved over time since 2008. We cover the 116 monetary policy meetings that happened during this period, and altogether there are 64 distinct governing council members in the data set. What you can see here in the form of the blue bars is essentially the breaches as counted by the ECB, and the pink plus the blue ones are the number of breaches that we identify in our revised series. So basically, when you look at this graph, you can see that there's quite a big difference between the two series at specific periods, in particular during the period between 2010 and 2014. Now, this is another interesting graph, and this slide basically illustrates another crucial fact, namely that breaching behavior is quite heterogeneous across governing council members. Some members literally never breach, while others literally seem to breach during every single quiet period of their tenure. So this is the kind of cross-sectional variation that we also try to exploit in our first set of regressions. Do something very simple here as an exercise. We basically regress a dummy indicating a breach at the statement level on a constant, a list of member, macro, and statement level controls, and time fixed effects or quiet period fixed effects. In a sense, the main takeaway is relatively simple, namely that we mostly find so-called zero results. We think that these results are actually nevertheless quite interesting or informative, namely for a couple of reasons. For example, the fact that we find no evidence whatsoever for home bias, nor for traditional career concerns. This kind of finding stands in contrast to other recent communication studies, and it also suggests that the quiet period's communication per se follows its own dynamics in a sense. We do find, however, that some variables proxying for policymaking experience and expertise are quite robustly correlated with breaching behavior. For example, if you look at service length, we find that conditional on making a statement, there is actually a strong nonlinear relationship between discipline during the quiet period and the service length. We find that discipline actually increases with time that a member spends on the council until a service length of about 5.5 years, and then it falls again. So we have a sort of inverted U shape here. Should also say that these results hold for both series, so the ECB series and our own reclassified series. And let me also emphasize that we very much consider our analysis as a stepping stone for future more targeted research in that area, particularly because we know that it is very difficult to differentiate between potential distinct underlying motives here in our context. Now, this slide summarizes our second set of results. What we do here is we look at, we look basically for systematic drivers of the differences between the ECB series of breaches and our own alternative series. And here we essentially regress the classification difference between the two series at the statement level on the same sort of covariates that we used in the exercise before. With the difference, of course, that the dependent variable here is a dummy that turns on if we classified a statement as a breach, which the ECB considered as unproblematic, and the reverse case actually never happens. Just to be very clear here. Now, from the entire control vector, only 3 variables are consistently significant in our findings. And these are the following, and these are the ones that you can also see in this table. So first, our results suggest that the ECB series may be underreporting breaches by the ECB Executive Board relative to those by national central bank governors. Of course, alternatively, you can also say that we tend to overreport these breaches. And if you remember the graph I showed you before, the two series are most different before 2014. And in fact, when we split the sample at 2014, we don't find any kind of effect of this ECB executive board dummy anymore in the later part of the sample. So one could perhaps argue that that the DG communications also followed a natural learning process here in classifying statements. At the same time, and I think that's also a very interesting finding, is that governing council members seem to have learned over time as well, as they, in a sense, have increasingly exploited what we think is actually a classification loophole here in that story. So in order to understand that, let me briefly explain. So many of the statements that we have in our data set start with phrases like, I'm not allowed to talk about this and this matter because we are currently in the quiet period. But what happens then is that these very same statements actually go on to discuss forbidden topics. And the issue is that most of these statements were classified as non-breaches. And this suggests that, these kind of exonerating phrases help members to avoid classification as a breach. And that's exactly what the second dummy, the decline to comment dummy that you can see here in this table, tries to capture. Finally, it also seems that the two series get closer to each other as the meeting approaches. So this is reflected in a positive coefficient on the last variable that we show here in this table, the days to meeting variable. And this finding suggests that the ECB is particularly strict in its classification activities just before the meeting, or that we actually, of course, become laxer in our standards as the meeting approaches. Now, I think perhaps the most interesting takeaway from this second exercise is, however, that we cannot explain a large portion of the deviations between the two series. So it appears to be hard, generally hard, or at least it was so for us, to replicate and explain the ECB's notion of what constitutes a problematic statement during the quiet period. Now, I'm already with my final set of results from this paper, and here we try to get at one specific aspect whether governing council members use of the question whether governing council members use communication during the quiet period in a strategic way. So what we do specifically is we exploit the fact that at each meeting since 2015, only 15 out of the 19 national central bank governors have a formal vote for monetary policy decisions. And so we asked the question whether non-voting members breach the quiet period more often in order to lock in their voting colleagues. So basically, in a sense, you can also call this a test of the narrative of the ECB's governing council as a collegial decision-making body. Now, our identification strategy here is based on the idea that the variation in voting rights is plausibly orthogonal to economic developments and monetary policy debates over time, because it was first introduced in 2015, this rotational principle, and since then the first schedule actually predetermined the sequence of voting rights ever since. So this enables us to exploit plausibly exogenous treatment to establish a causal relationship between bearing and not bearing the right to vote and preaching behavior. Now, interestingly, again, we find absolutely no positive treatment effect here. So we find 0 results again. That means that we find no evidence for strategic communication substituting for voting rights during the quiet period, which seems to be good news, of course, for the governing council. Now, in the interest of time, I'm gonna jump the checks and the additional results that we also provide in the paper, and I'm gonna just refer you to that paper because I think that might be more interesting for all of us here. Finally, so let me briefly summarize what we find and what we do in this paper. So basically, to sum up, our findings include a list of 0 results, which nonetheless we think bear relevant policy implications and also some good news for the ECB in a sense. On the one hand, we find no evidence that home bias drives quiet period breaches. Second, in contrast to other recent work, our sort of no results on the effects of rotational voting actually strengthens the collegial decision-making narrative of the ECB Governing Council. And finally, an interesting point we think is that the conventional proxies for career concerns in our setting actually remain insignificant throughout, like age, for example. And based on the relevant literature in this area, this could imply that stronger transparency measures may have little disciplining effect in the case of the ECB, but of course that's something that needs to be further investigated. Now, we also think that our paper assigns some homework to policymakers, in particular regarding the clarity of quiet period rules. The record here shows that quiet periods were only partly effective, of course. That's something that we saw very clearly in the graph in the beginning. And one reason for this could be that the rules and the classification of statements are not crystal clear at the moment. So this is also the impression that we got from our reclassification exercise. And so we think that it might be worthwhile to think about the current quiet period rules in more detail. Finally, if you wondered, in ongoing research, we are trying to reverse engineer in a more normative way what should be considered as a breach by looking at the market impact of statements. And we also look at the anonymous breaches and what drives them essentially during the quiet period. So thank you very much for your attention and for the opportunity to present.
Thank you very much, Kilian. So please use the chat box if you'd like to make any questions. We do have a few minutes for Q&A on this paper. So may I ask myself, Kilian, you are alluding to perhaps something like this in your work in progress plan, but so did you so far try to look at any time variation, any systematic time variation in the patterns that you? What I might have in mind is that at least with hindsight, there might have been certain issues of policy that have attracted more debate among the policy makers, and even some with some there may be more disagreement than with the others. Would that potentially show up in your results, or is it something that you could perhaps look at?
So thank you very much. It's a nice comment and question. So basically, so we tried to get at a couple of things. I mean, one thing is, of course, that we have the quiet period fixed effects in there. So we always have, to think about getting them out, or rather like getting dummies in for some specific events, etc., etc. So this is something that we've tried at least for a couple of things like the projections, so the BMPE and the MPE. So when these are released, we try to investigate whether the quiet periods that fall into projection periods are more prone to actually generate to generate breaches than quiet periods that don't have the projections. But most of these cases, we actually find no consistent results. But I think another dimension of your question relates to actually the content of the breaches itself, and that's something we are currently still working on. So far we haven't really worked on the insides. We're trying to tag the topics and so forth, and this is something we are looking to do. We are looking to do in future research.
Thank you very much, Kilian. I don't see questions in the chat at the moment, but please also later on. Okay, I see one question now from Ernest. Is there comparable research for the US Fed? What does it yield? How would US results compare with yours for the Eurosystem? If there were differences, what might be explanations?
So that's a good question. So I don't know of any comparable research on specific quiet period breaches for the US. I think there are obviously large differences in terms of how committee work and how decisions are organized and communicated in the US and in the Eurozone. We know much more. We have much more attributable information for the US than we have for the Eurosystem. So I guess the dynamics might be very different. Also, so this might be like a sort of first jot of the information first attempt to answer this question. But I have to think about this more, I think. So in terms of an ad hoc answer, I cannot provide any more details at the moment. But yeah, but thanks for the question. We'll keep it in mind.
Thank you very much, Kilian, for this very interesting piece of research, and good luck with the work in progress with it. So I think we could now move to the paper presented by Markus Haavio. So it seems that the connection is now fine. The paper that was supposed to be presented first, but nice that it seems to be working now. So please, Markus, the floor is yours.
Okay, so can you hear me now?
Yes, we can hear you.
Okay, that's very good. Right. Okay. Right, can you see my screen?
Yes, we do.
Okay, right. So the title of the presentation is Reading Between the Lines Using Text Analysis to Estimate the Loss Function of the ECB, and this is joint work with Marita Paloviita, Pirkka Jalasjoki, Juha Kilponen, and Ilona Vänni. So this is really a joint effort from the Bank of Finland. So kind of background. So the ECB, or the Eurosystem, completed the strategy review earlier this year, and well, the most important change that it made to its strategy concerned the ECB's definition of price stability. So in July 2021, the ECB Governing Council adopted a new definition of price stability. And I quote, the Governing Council considers that price stability is best maintained by aiming for a 2% inflation target over the medium term. This targeting is symmetric, and symmetric is here the key word, meaning negative and positive deviations of inflation from the target are equally undesirable. Well, this definition differs to a certain extent from the earlier definitions which were in use until July 2021. The earlier definitions will be perhaps best summarized by the kind of bunchword or a slogan, close to but below 2%. So in this paper, we are basically trying to find out or assess how important this change of strategy or the change in the price stability objective is going to be. So we are trying to compare the symmetric 2% to this below but close to 2%. So the new definition of price stability implies it's quite clear implications of what the ECB's policy preferences should be from now onwards. So the ECB's loss function should be symmetric, that said in the definition of the new definition of price stability, and also this point should be at 2.0%. Well, if you think about the policy preferences of the ECB under the old strategy, well, the old strategy was less clear and more open to interpretation. So the old strategy said that the price stability objective should be below but close to 2%. But what did that mean? That could have meant, for example, that the de facto inflation target of the ECB was something like 1.95%. But I mean, other interpretation could be also possible. It was much lower, like 1.5%. And also that the inflation should be below 2%, that was given different interpretations. So, for example, some people thought that that was some kind of ceiling, so that the ECB not tolerate inflation levels higher than 2%. That would also imply that the ECB's loss function would have been asymmetric under the older definition of price stability. So that the ECB disliked high levels of inflation more than it dislikes low levels of inflation. But then again, also different interpretations were given on that account as well. So basically saying that, well, no, the ECB was actually also symmetric under the old definition. So basically, the key questions that we try to answer, so we try to estimate the ECB's loss function under the old definition of price stability, and the key questions we answer or try to answer are: one, was the loss function symmetric or asymmetric with respect to inflation under the old definition? And was the bliss point 2.0%? And if not, how much did it differ from 2.0%? So addressing these questions allows us to compare the ECB's old and new definitions of price stability, and also try to assess how important, how big or small this change in strategy actually is going to be. So how are we going to, so what approach do we take when we try to estimate the ECB's loss function? So we basically try to use the qualitative communication about the ECB's Governing Council's preferences. So basically, we take the introductory statements of the Governing Council's press conferences after the monetary policy meetings and try to kind of find out by reading between the lines how happy or unhappy the ECB is with the current situation. And then we combine that information with the Eurosystem, so ECB staff's macroeconomic projections. And well, that kind of allows us to link the ECB's level of satisfaction to the current macroeconomic situation. So in more detail or in more specific, we apply the approach suggested by Shapiro and Wilson in the application to the Federal Reserves that's forthcoming in the review of economic studies. However, well, our approach differs a little bit from Shapiro and Wilson, in particular in the sense that we are more interested, for example, in finding out whether or not the ECB's preferences have been asymmetric, because this asymmetry or symmetry aspect is not that important for the Federal Reserve. So before I move on to more detail to this text analysis, I try to kind of contrast this text analysis approach to perhaps more standard reaction function estimations. So another way of trying to figure out what the ECB's objectives and actions have been could have been to estimate the reaction function, which basically tells that how the ECB, for example, changes its interest rates in response to inflation and the general economic outlook. We think that there are a number of reasons why the text analysis based approach might be preferable for our particular question. So the first reason is that the new definition of price stability kind of implies that the ECB's loss function should be symmetric with a bliss point at 2.0%. However, you cannot infer, at least directly, from this new definition of price stability what the ECB's reaction function is going to be under this new definition of price stability. So even if the policy preferences are symmetric, this does not necessarily mean that the reaction function will be symmetric. So, for example, the effective lower bound may imply asymmetric reactions. So even outside the effective lower bound. So, for example, the ECB may want to prevent, let's say, deflationary spirals, and that's why it may react more aggressively to low inflation than to high inflation. So, well, on the other hand, you could, of course, first try to estimate the loss reaction function and then try to infer the loss function from the reaction function. But also that would be somewhat problematic because that would involve making some rather specific assumptions about the overall structure of the economy. And then the third point is the zero lower bound of the effective lower bound. For example, the Eurozone has been at the zero lower bound from 2014. So there would be two options for reaction function estimations. You might end at the effective lower bound, and that would, of course, involve losing lots of data for the euro area, or rely on highly uncertain shadow rate estimates. So now how do we proceed with this text analysis approach? We adopt a rather simple approach of so-called bag of words. So we use the Logran and McDonald finance-specific dictionary. It basically just gives you a collection of words which have either a positive or negative connotation. And then we just calculate the difference of the number of negative and positive words, and we normalize that with the total number of words in the ECB's introductory statement. And basically that just gives us the negativity index, which tells you how happy or unhappy the ECB Governing Council is with the economic situation. So here's, for example, an example with positive and negative words. So the risk surrounding the economic outlook for the euro area continue to be on the downside. In particular, the weakening, that's a negative word, in the euro area's growth momentum alongside with heightened political risks could dampen, and once again dampened, that's a negative word, confidence, and in particular private investment. In addition, insufficient progress in structural reforms in euro area countries constitute a key downward risk to the economic outlook. Now, the kind of combination of two words, insufficient progress, that's related to a somewhat more subtle point. So handling negations. So progress in itself, that's a positive word. but it is preceded by a negation, insufficient. So this expression, insufficient progress, that counts as a negative expression in our approach. So now let's see what this tone or net negativity looks like for the Eurozone. So that's shown in this picture. So you can see a few key characteristics. So the net negativity index reaches its peak during the financial crisis. That's kind of rather intuitive. And also you can see the Euro crisis. Also in that situation, this net negativity is at a heightened level. Preceding the great financial crisis in 2005 and 2006, net negativity was falling, which is also rather intuitive. So we are mostly interested in this tone and inflation. So here's some kind of a scatter plot that gives you on the horizontal axis inflation and on the vertical axis net negativity. To get some kind of idea or some kind of what kind of pattern emerges in the picture on this slide is some kind of very simple non-parametric estimator. So we have inflation arranged for buckets of width 0.2 percentage points, and then on the horizontal axis you can see just the average tone in each of these buckets. And what you should discern from this picture is that some kind of V-shape or U-shape pattern emerges. And that's kind of good news because we typically think that the loss function of the central bank should be V-shaped or U-shaped. And you can also see that the bottom of this loss function seems to be somewhere in the neighborhood of 1.6 to 1.8% inflation. And that also already gives you some kind of indication of what kind of results we are going to find. So we then move on to constructing or estimating some more parametric loss functions. So we consider two very simple loss functions. The first loss function is just V-shaped. So here the expression 3 tells you that the loss function is basically just the difference of current inflation from the inflation target, or the inflation gap. That's just the loss function. And then we just relate these loss function to the tone by adding some an intercept, that's alpha, and some kind of scale parameter, delta. We can also try to analyze asymmetry, so we can think that or assume that the slope of the loss function can be different when you are below or above the inflation target. That's something we can estimate, and that's something we can also then test statistically, whether or not the loss function is symmetric or asymmetric. Another loss function that we consider is LINEX, or linear exponential loss function, which as a special case also includes the standard U-shape or quadratic loss function. So here the key parameter is theta. When theta goes to 0, we just get the U-shaped symmetric loss function. And in particular, when this theta that's higher than 0, the more asymmetric loss function becomes, and the more the ECB dislikes high inflation more than low inflation. So this is once again one way of estimating and also testing the hypothesis that the ECB's preferences have been symmetric or asymmetric. Okay, right, then on the right-hand side, we just use short-run real-time Eurosystem macroeconomic projections for inflation and output gap. So the average of inflation nowcast and 1 quarter ahead projected inflation rate, and the same for also output gap. So this is basically the same approach as Shapiro and Wilson adopt in their study of the Fed. Right. Okay, and so some kind of overview of results. We do actually indeed find evidence that the new definition is different from the old definition. So the ECB has been either more averse to inflation above 2%, or the de facto inflation aim has been considerably below 2%. Just try to illustrate these findings with a couple of pictures. So first of all, here are on the left-hand side is a V-shaped estimated loss function, and on the right-hand side a Linux loss function for the ECB. In these estimations, we have also tried to estimate the bliss point or the de facto inflation aim of the ECB. So if you, for example, look at the left-hand side panel, the V-shaped, you can see that the bottom of this V-shaped loss function seems to be somewhere around 1.7%. So, well, below 2.0%. But on the other hand, well, that loss function looks quite symmetric, so that it doesn't really provide that much evidence in favor of the claim that the ECB has been more averse to high inflation than to low inflation. With the Linux loss function on the right-hand side, you get a pretty similar picture. So the bottom or the bliss point is somewhere below 2%, but also this Linux loss function looks rather symmetric. Then we, so a couple of words how we select the de facto inflation target. So we just do a grid search, and the selection criterion is to minimize the sum of squared residuals. So in this example we have on the left-hand side, that's for V-shaped loss function, the de facto target or the bliss point of the ECB has seemed to be something like 1.6%. That's the bottom of this sum of squared residuals criterion. Okay, we also do estimations where we set the inflation aim to 2.0%. So here the question or the kind of setup is the following. Well, we kind of assume that the de facto inflation target under the old strategy was exactly the same as it is now under the new strategy. But we are then trying to find out that whether, giving this assumption, the loss function was symmetric or asymmetric. And just by eyeballing the V-shaped and the Linux loss functions, you can see that in this case, we do actually find evidence in favor of asymmetries. So that if the ECB's inflation target was 2.0% in the past, then actually the ECB disliked high inflation more than low inflation. So once again, this is evidence saying that even if we assume that there's no change in the bliss point of the loss function, the shape of the loss function will be different under the new regime than it was in the old regime. Okay, right, so we also do more systematic and more formal economic analysis, but in the interest of time, I just skip that. Then we do a number of robustness checks. We also, for example, construct an alternative tone based on only inflation texts. So we, using certain criteria, we identify the texts which are strictly kind of related to inflation only. We build an tone index based on those texts and then analyze them. So here's the basically the general tone that I showed you earlier on the ECB's net negativity, and the alternative tone you can see on the right-hand side. Well, these tone measures, well, they seem kind of qualitatively quite similar. For example, both of them have the peak of net negativity during the Great Recession or the financial crisis. The alternative tone based on only inflation text seems to be a little bit bumpier, but that might be just the simple reason that it is based on kind of smaller text mass than the general tone. And then, well, the estimation results that we get from using this alternative tone, they are pretty much in line with what I already showed you for the general tone, although we do get a little bit less evidence in favor of asymmetries. However, we do get rather strong evidence telling that the de facto target was considerably lower than 2% under the old regime. So conclusions, the ECB's new definition of price stability adopted this July implies a symmetric loss function with a bliss point at 2.0%. Under the now old definition of price stability, ECB's loss function was asymmetric and or the bliss point was considerably below 2.0%. So kind of in sum, we provide evidence that the new definition or the objective function that it implies is indeed clearly different from what the now old definition implied. And so these results are robust to the tone measure. So we used the general tone or the inflation-specific tone. The functional form of the loss function, we used the piecewise linear and also the Linux loss function. We used frequency of observations either quarterly because the ECB publishes its macroeconomic projections every quarter, or monthly, well, because there are monetary policy meetings every month or every 6 weeks. And it's also robust to the inclusion or exclusion of the output gap terms as control variables in the loss function. And well, the two interpretations of the old definition of price stability, well, one can say that they are probably not harmful or actually quite well suited for a situation when inflation and inflation pressures were high, but then possibly counterproductive in a low rate environment because, well, they might have lower inflation expectations, also reduced monetary policy space, and increase the probability of hitting the effective lower bound. And now the new definition of price stability may be better suited for low rate environment, but of course that remains to be seen. So thank you, that's all.
The floor is now open for questions for a couple of minutes, and then we will continue with the program. But please, if there is any questions, so please use the chat. Markus, I just have a very quick question myself. I suppose that you are busy text analyzing the latest statements after the strategy review, but I might think that it's too early to ask about any results or observations regarding any changes.
Yeah, that's a very good question, and also kind of because the format of these introductory statements was changed a little bit. So, but I mean, yeah, as you said, that there's so little evidence so far that I think we could do this kind of follow-up study in a couple of years' time, and of course, that would all allow us to use not only this qualitative information, but also the more quantitative information about the monetary policy decisions.
Okay, thank you very much. And thank you both again, Kilian and Markus, for the excellent presentations. It was certainly very worthwhile to not only have lunch during the lunch break, but also to listen to your presentation. So thank you again very much. And we are right on time. So if Ernest Gnan is ready to chair the next session. So Ernest is my dear colleague from SUERF, the Secretary General of SUERF, and comes from the Austrian Central Bank. So please, Ernest, the floor is yours.
Thank you very much, Esa. It is a great pleasure to do this conference together with you. As always, super smooth preparation and work experience. Thank you so much. Welcome to this session number 2 on central banks in a changing world. The global financial crisis, the euro area sovereign debt crisis, and now the COVID crisis have fundamentally changed the environment in which central banks operate and the challenges and policy considerations which central banks face. This session addresses 3 themes among these many challenges, which actually Governor Rehn already briefly touched upon in his opening remarks. First, how are central banks affected by climate change, and how should they react in terms of the catalogue of goals, their monetary policy strategies, their decisions on the appropriate stance in the face of demand and supply side economic shocks from climate change and from climate protection measures? And how might central banks adapt their own instruments to support climate protection and the energy transition? Second, the distributive effects of monetary policy have moved center stage given the long duration and the very low level of nominal and real interest rates and the large volume asset purchases. These measures have strongly affected relative prices in asset markets, most notably housing, stock and bond prices. They have implied a distribution from savers to borrowers, private and public, and have benefited the owners of real assets. At the same time, expansionary monetary policies have supported growth and employment, thus benefiting workers. A third issue, which has moved center stage, is the relationship between monetary and fiscal policies. With low inflation and interest rates close to the effective lower bound on interest rates, fiscal policy gains potency and importance relative to monetary policy. Central banks' large-scale sovereign debt purchases in reply to the GFC, sovereign debt crisis, and to the COVID crisis have welded monetary and fiscal policies together, quite in contrast to the prescription of a strict separation during the Great Moderation. So some observers are asking, are we facing a shift from monetary to fiscal dominance? Again, Governor Rehn pointed to this topic already. We have 3 excellent speakers to enlighten us on these 3 topics. Anna Breman, Deputy Governor of Sveriges Riksbank, will start out on central banks and climate change. Then Fiorella De Fiore, Head of Monetary Policy at the BIS, will talk on monetary policy and inequality. And third, Leonardo Melossi, Senior Economist, Economic Advisor from the Federal Reserve Bank of Chicago, will address policy interactions between monetary and fiscal policies. Each speaker will talk for 20 minutes, then we will use the remaining 25 minutes or so for reactions and Q&A. May I encourage you all to pose your questions in the chat. Without further ado, Anna, welcome, and the floor is yours.
Thank you very much, and thank you very much for inviting me here today. Central banks are indeed facing a changing world. The past 2 years have been unusually dramatic, and I must say that when the pandemic hit at the beginning of last year, I thought that the topic that I will talk about, climate change and central banks, that would have to take a step back. That we would focus entirely on crisis management. And that actually did happen. In the first months of the corona pandemic, we did take a step back from working on climate change, and we focused on the acute phase of handling the crisis. but much faster than I thought. I noticed that not just us, but many other central banks started working on climate change again. So already by the summer of 2020, there were a lot of work going on within the central bank community. Just give you an example to put some sort of number on this. When the pandemic hit, the NGFS, the Network for Greening the Financial System, had 55 members. Now, just over a year later, they're up at 95 members. So this is clearly a topic that's growing within the central bank community. When we're talking about this subject, I think we should actually start by looking at the physical science, what the climate scientists are saying. So let me just show you one slide. And this is from the latest IPCC report. And climate scientists, they distinguish between warming of the atmosphere, the ocean, and the land, and the complex effect on our economies. And I'm sure that all of you have either witnessed or maybe even experienced yourself some of these effects from extreme heat, flooding, or even fires around the world. We have new reports almost daily on these kind of events affecting households and firms, and therefore our economies. There's also empirical research coming up showing that these kind of extreme weather events already have an effect on inflation, not just in developing countries, but also in advanced economies. So if we look at the economic perspective of climate change, we know that the problem stems from a failure to put a price on a negative externality, the emission of greenhouse gases. And the first best policy response would be to put a price on carbon, and that price should be global, for example, a global tax on carbon emissions. So economists actually want policy to change the relative price between goods and services that emit greenhouse gases and those that don't. And then you can think, well, if you're in the central bank community, we're not concerned about relative changes in relative prices. We care about changes in the overall price level. So why should we care about climate change? Well, there are several reasons, and the first one I've already told you. I mean, it is already affecting our societies. It's affecting households and firms, and therefore economic development. The other one is that climate change will pose, to an increasing extent, challenges for monetary policy setting. It does affect price stability and financial stability, and therefore we need to be prepared to deal with those difficult trade-offs that we might face. And the third one is that we have to consider whether we should, and in that case, how we should ourselves adjust our monetary policy tools and other tools to also combat climate change. So here at the Riksbank, the Swedish Central Bank, when we talk about climate change, we divided our work into three different categories. It's research, it's regulation of financial markets, and it is readjustments of our balance sheet. So let me take them one by one to explain how we are thinking regarding this issue. This is a simplification. In reality, it's much more complex than what I'm showing you right here. But when you look at how economists are trying to think about the different channels through which climate change will affect not just our economies, but also monetary policy going forward, these are the channels that we tend to talk about. One is the physical risks, and that's the gradual warming in itself, but also the more frequent extreme weather events that we are already facing. The other part is transition risks. And I think that this word is a little bit, it's not a good word to talk about transition risk, because transition is necessary. We need to see a transition towards net zero. But even if this is necessary and the transition in itself is good, it can pose risks, for example, to financial stability. We will see repricing of different kinds of assets. We can see some of the policy measures that are needed, like a price on carbon, could have effects, complicated effects on inflation dynamics. It is a relative price change in the end, but it could also affect the overall price level if we see large second round effects or effects on inflation expectations, for example. And the third one that I think we always should mention is the risk of tipping points. And tipping points are things like rainforest decimation or melting ice caps. And we don't know, we can't say with certainty that they will happen when you pass a certain threshold in the gradual warming, but it is a risk, and the IPC says that we cannot rule it out. And the recommendation is therefore to introduce policy so we can keep global warming well below 2 degrees, preferably below 1.5. I want to give you an example on why I believe that this is something that we already should be prepared to deal with. And I'll use Swedish inflation data as an example. This is CPIF, that's our preferred measure of inflation. And here you see 2014 until 2019, sort of a well-behaved upward trend in Swedish inflation. And then the pandemic hit. And first we had a sharp fall down in CPIF, and then a rebound. And we're expecting, as most of Europe, inflation to keep on going up in the near term, and we expect volatility to continue. But the thing then, when you see this graph, you tend to think, well, we had the pandemic. So first there was the pandemic that hit the price level, and now we have a rebound. But if you look at the real main drivers of the large volatility we've had in inflation over the past year and a half, it's energy prices. And there are two factors here. One is actually just weather-related effects. Beginning of last year, we had a warm, wet, and windy winter. We have a lot of hydropower and also wind power, so that caused a sharp fall in energy prices. And now we have the reverse trend. We have not so much water in the magazines. We don't use gas for heating or generating electricity in Sweden at all, but the European energy market is affecting the Swedish price level, the energy prices on the margin. So you see this large effect. And if you go into the details, I'm not saying that this is the whole story, but I'm just illustrating the weather effects and also the transition risks. For example, when people are transitioning away from coal, many countries at the same time, towards gas, and we get gas shortages, it can have an impact on inflation. And that is difficult to judge in terms of forecasting how persistent these effects will be, whether we'll see second round effects, whether we'll get an effect on inflation expectations. So that's one point. So when you are, as a policymaker in real time, it is hard to judge whether it is a relative price change or an overall increase in the price level that we are experiencing. The second area that I wanted to talk about is regulation of financial markets. Both physical risks and transition risk are clearly a threat to financial stability. In Sweden, it's the Financial Supervisory Agency, the FSA, that has the main responsibility for regulation of financial markets. But the Riksbank do work very actively in many international organizations that are currently working on this topic. For example, the Basel Committee on Banking Supervision, the ESRB, we're active in the Network for Greening the Financial System, and we're also participate in various committees in all these other organizations that I'm showing you. And one of the key points when we move on to the next stage, when we look into risks on our balance sheet, it is that there's not enough data. There's not enough disclosure of climate-related risks in the financial system. And there is an ongoing work within those international organizations trying to foster better climate-related disclosures. And I'm glad to say that I'm hoping that we can have some positive news at COP26 in just a few weeks, but we'll see how far that will take us. Because this question of disclosures and actually being able to measure the risks is one of the things that we are working with when we look at our balance sheet. So let me get into the most difficult question, and that is whether central banks should readjust monetary policy tools and other tools to also try to combat climate change. Central banks' mandates, they vary, of course, across countries, and each central bank will approach this from a different perspective. So let me just explain the legal framework that we are working within and how we have reasoned. Similar to other central banks, the Riksbank's primary mandate is price stability. But in addition, the Riksbank Act clearly stipulates that we have an obligation to consider risks on our balance sheets. So it follows from this that the Riksbank, among other things, shall manage its own risks associated with climate-related risks. And in addition, Sweden is not a euro area member, but we are a member of the European Union. So both the EU Treaty and the Riksbank Act also stipulates that as long as our primary mandate is met, price stability, the Riksbank shall support the objectives of the general economic policy to promote sustainable growth and high employment. So these three things taken together means that we see that we have an obligation to act when it comes to our balance sheet from a risk management perspective. So what have we done in practice? Well, the first thing we did, here you can see FX reserves, so foreign exchange reserves. The first thing we did was in 2019. So we took the decision that in addition to looking at risk and return on our balance, on our foreign exchange reserves, we should also take into consideration sustainability, and particularly the carbon footprint in our FX reserves. So what we have done is that we've reduced the carbon footprint by reallocation across assets. And what we've done is that we decided to sell bonds issued by Canadian provinces and Australian states with emissions higher than the national average in favor of bonds issued by states and provinces with a lower carbon footprint. And because of this, the carbon footprint of the whole FX portfolio has been reduced. But these FX reserves are not held primarily for monetary policy purposes. What is held for monetary policy purposes is our large-scale asset purchases. So the Riksbank has since many years bought government bonds, and when the pandemic hit, we expanded the large-scale asset purchases to also include covered bonds, municipality bonds, and corporate bonds. And in November last year, in 2020, the Executive Board announced two decisions related to the corporate bond purchases. And I want to stress that the board voted unanimously in favor of these decisions. So first, we introduced negative, norm-based negative screening in the corporate bond purchases. And this means that we only offer to buy bonds from companies deemed to comply with international standards and norms for sustainability. And one such example is the principles in the UN Global Compact. We use an external provider to do the negative screening for us, but the board makes the final decisions. The other decision that we took is that we will measure and also report carbon emissions related to our holdings of corporate bonds. And there are two reasons for this. First, we want to be as transparent as possible about the bond purchase, but we also want to foster firm-level reporting on climate-related risk, because we know that it's difficult to get this data to actually assess the risks. And on this graph, you can see how many firms within our eligible universe, and the eligible universe is investment-grade corporate bonds issued in Swedish krona. And you can see that over the past few quarters here, the number of firms that are reporting has increased from about 37% to 45%. And you can see it varies a little, and I'm in no way claiming that this is just because we are showing this data that we've seen an increase over time, because we also see that the eligible universe is changing. There are some new companies that are being added to the eligible universe, and that can explain these differences. But another interesting fact when we look into this is that there is a big difference between listed companies and non-listed companies. So among the companies that are listed, about 80% actually report emissions themselves. Among the non-listed companies, these are also investment grade companies. The very, very few are actually reporting on their emissions. So when we report on emissions, we take the data provided by these corporates, but we also again use external data providers to be able to make an estimate of the carbon intensity and the footprint of our corporate bond portfolio. Currently, I looked at the latest numbers, and our estimate, I have to look in my papers here, it's measured to be 126 tons CO2 per $1 million in revenues. And I know that that has also declined a little bit over time, but this is probably due to the composition effect. We don't expect to see large changes over just a few quarters. I'd also want to stress that the negative screening is a sustainability screening in a wider sense. We do not exclude any firms based on an exact level of emissions. The data is not reliable enough, and there would be other difficult issues if we aim to do so. But I'll be happy to discuss that further during the discussion. To conclude, well, I want to stress three things. The first one is that climate change is already a threat to price and financial stability. And as central banks, we have to prepare for those risks increasing over time and be prepared to face some difficult decisions in also setting monetary policy. The second one, I want to find a link to the next topics of this session, because climate change is also clearly a big challenge when it comes to income inequality. One of the reasons why it's so difficult for governments around the globe to actually agree on the price on carbon is that it tends to have an effect on income inequality, and it tends to hurt the poorest households the most. Climate change in itself tends to hurt the poorest households the most. And the third one is also that when we talk about the interactions between monetary and fiscal policy, and we talk about some of the tools the central banks potentially could use to contribute to fighting climate change, there are some difficult issues whether we're getting too close to fiscal policy. I gave a speech on that in February, and I'm also very happy during the discussion to discuss that. But I'll stop there, and thank you for listening.
Thank you very much, Anna, for this excellent overview and also for sharing your own experience in Riksbanken in Sweden. This is very valuable for us. Let me now turn to Fiorella. What's your take, Fiorella, on monetary policy and inequality? Anna already hinted to this topic, which is also quite central to us. Fiorella.
Thank you. Yes. Yes, I will talk about this issue of particularly the distributional footprint of monetary policy, and this will be very much based on the chapter 2 that the BIS published in its annual economic report. So if we move slide, there has been a growing interest in inequality in the public debate since the great financial crisis. In part, I don't see the slides, do you?
Not yet. Could you please upload the slides?
Thank you.
Excellent, thank you.
The first slide. So there has been this increasing interest in the public debate about inequality since the GFC. This has probably reflected the fact that policies that have been deployed since the crisis to reduce its impact and to support the recovery have been viewed by some as benefiting disproportionately the rich, particularly because of the rapid increase in asset prices. Central banks has also devoted increasing attention to this topic, as witnessed by this graph here, which plots the share of central bank governors' speeches on topics that include the dimension inequality or distributional implications of monetary policy. And what you see is that the proportion of speeches that refer to inequality have increased, especially since the great financial crisis, and particularly so in advanced economies, here reported as with the red bars, than in emerging markets, here in blue. Next slide. My image freezes. Is it what you see as well?
We see the outline of the talk.
Okay, I don't, but let me then move to this outline. Well, I will first describe recent trends of rising inequality, and I will point to structural determinants of these trends, which I will argue are largely independent of monetary policy. I will then address the role of central banks in shaping inequality over the medium term through the achievement of their objectives and mandates. And I will then move to discuss how inequality affects the transmission of monetary policy and therefore also its conduct. And before concluding, I will briefly touch upon what I think are the main backstops against inequality. Next slide. So let me first put the theme of inequality in perspective by looking at the long-run evolution of the inequality trends across different countries. Next slide. It's important to stress that rising trends in inequality started well before the Great Financial Crisis and the widespread use of unconventional monetary policy tools. Income and to some extent also wealth inequality have progressively become more polarized since the 80s. Now, the left-hand panel, so my image is frozen, so I don't see it. Please let me know if the slide does not show up as I'm talking. So the left-hand side of this panel shows two different measures of income inequality. The Gini index, which is shown with the solid lines, and the share of income that accrues to the top 10% of earners, the dashed lines. Those indicators show that there has been a substantial increase in inequality since the 80s, and especially so for advanced economies that are here indicated with the red lines. Now, measuring wealth inequality, as done in the right-hand panel, is less straightforward, in particular because of the problems that arise when you're measuring or evaluating illiquid assets. Now, that being said, the available data show that there has been also an increase in the wealth Gini index over time, although to a different extent across different countries. So it seems to me that it's hard to argue that central banks' accommodative policies have been the main driver of something that has started way before the use of these accommodative policy and conventional tools, and that has been ongoing for several decades. This seems to suggest that the long-term drivers may be rather of a structural nature, and indeed there is a large body of the literature that has documented the contribution of globalization and technology to inequality. Next slide. So, I think it's interesting to notice that the increase in inequality is mostly driven by the increased polarization at the income at the very top. Here, the left-hand panel in the slide shows the composition of the change in the share of income that accrues to the top 10 earners. And it shows that, especially in advanced economies, the increase has been driven to a substantial extent by the contribution of the top 1%, indicated here with the blue lines, the blue bars, or even by the top 0.1% of earners, indicated by the yellow bars. In contrast, the top 10% earners, excluding the top 1%, which are indicated here by the red bars, have not contributed as much. And this is even more so for wealth inequality, which is documented in the right-hand panel. So for example, if you look at the column for the US, you can see that the share of wealth that is held by those in the top decile, but not in the top 1% of the income distribution, again, the red bar, has actually declined. And this decline has happened to the advantage of the top 0.1%, which are denoted here with the yellow bars. Next slide. So even if inequality is in the end largely the result of structural forces that act over the long term and are independent of monetary policy, central banks can and do play an important role in mitigating inequality over the short to medium horizon. And over this horizon, what matters most for two major sources of inequality are inflation and recessions. But controlling inflation and mitigating recessions is indeed what central banks' mandates are about. So next slide, which allow me to first look at inflation and the role of inflation for inequality. So inflation is typically portrayed as a regressive tax. The poorest are those that see their purchasing power, the purchasing power of the wages shrink when prices increases. And they are also those that are least able to protect their savings. And this is mainly because their wages are typically in nominal terms. This graph provides some stylized evidence that about inflation and inequality, and it shows the change in the Gini index after episodes of where inflation is conquered, meaning that it is brought below the threshold of 5% on a persistent and sustained basis. And this exercise covers 34 episodes across advanced economies and emerging markets since the 90s. And what you see is that in emerging market economies, income inequality declines both on average, the blue line, but also in general, the shaded line, which denotes the interquantile range. Now, interestingly, in advanced economies, this does not seem to be the case. The change in the Gini index, here reported with the red line, mimic closely the change observed for countries that did not experience a reduction in inflation, which is denoted by the black line. And one explanation could be that other offsetting factors like technological progress and globalization may have played an important role in those countries. Next slide. Now, a second common mandate of central banks is ensuring macroeconomic stability. Recessions tend to widen inequality as the unskilled are the first to lose their job and become unemployed. And when they're unemployed, they see their skills deplete much faster than the more skilled workers, and they may find it difficult to re-enter the labor market on the same position or at the same salary level once the economy recovers. So this graph confirms this intuition. It indicates that following recessions that are here indicated by the vertical dashed line, dotted line, after these recessions, the unemployment indicated in red typically increases before returning back to pre-crisis levels. And so does also inequality, but more persistently and with a larger impact than unemployment. And this is indicated by the blue line. Next slide. Now, recessions that are associated with financial imbalances here that we identify here as recessions that are preceded by excessive private sector debt service ratios tend in general to be deeper and longer. And this graph shows that following financial recessions, here indicated again by the vertical dash line, the increase in unemployment is larger and more protracted than that for normal recessions. Where here the financial recessions are denoted with the blue line and the normal recessions with the red lines. Now, next slide. So what I've said so far is that if central banks manage to stabilize inflation and output and to smooth the financial cycles, they already contribute to mitigate inequality trends. But it's also true that rising inequality affects the transmission of monetary policy and complicates also its conduct. Next slide. First of all, there is evidence that recessions tend to be deeper in more unequal economies, possibly reflecting a larger share of vulnerable workers. This is shown in this graph. We see that in a sample of 22 advanced economies and 27 emerging markets over the past 6 decades, recessions that are proxied here by an increase of 1 standard deviation in unemployment. These recessions generate larger declines in consumption growth as we move from lower to higher inequality countries. Next slide. It is also true that inequality may affect the transmission of monetary policy and weaken it. One possible reason is that households at the bottom and at the very top of the income distribution exhibit lower sensitivity of consumption to changes in the interest rate. So those at the bottom of the distribution may have a higher propensity to consume out of their income, but they may face borrowing constraints, so they may not be able to take advantage of the decline in interest rate and the more favorable financial conditions. And those at the top of the distribution, they can easily obtain credit, but they may have a low propensity to consume out of their already high consumption levels. And the empirical evidence presented in this graph is based on a panel regression across advanced economies. And it shows that the effect of a monetary policy shock on cumulative consumption growth. And here you see that inequality tends to dampen the transmission of monetary policy because consumption seems to respond more to an unanticipated monetary policy easing when income inequality is lower. It is when the dots are of a lighter color. Next slide. Now, because of diminished effectiveness of the monetary stimulus when inequality increases, central banks may have to cut more aggressively and for longer interest rates. And this might have a larger impact on wealth inequality. Low interest rate may lift asset prices, especially those of equities, and may also increase the wealth of the rich. But this outcome is not a given because it depends on the structure of asset holdings in the economy. And in particular, if home ownership is sufficiently dispersed, wealth inequality could actually decrease rather than increase. And this is what this slide shows. The left-hand panel illustrates that low interest rates boosted the price of assets after the GFC, more so for equities that are indicated with the red line than for housing, indicated with the blue line. Now, whether this actually pushed inequality up or down really depends on the structure of asset holdings. Aggregate numbers are here reported in the middle, in the center panel, and you can see that they vary a lot across countries. For example, in France, the bulk of wealth is housing, shown here as a share of total household wealth and denoted with the red bars, while equity, denoted with the orange bars, plays a tiny role. And so equity that plays a little role, a lower role in France, seems to be instead much more important in the US. So the effects of increased asset price on inequality is likely to be higher in countries where equity plays a larger role, like the US, and lower in countries where housing plays a larger role, such in France, because an increase in in a housing prices may benefit a large share of the population if there is a widespread ownership of a housing. And this seems to be confirmed by available data on wealth inequality, as shown in the right-hand panel. The increase in inequality after the GFC, when asset prices increased, seems to be relatively smaller in France than in the US. Next slide. So let me finish by arguing that structural trends in inequality are not given. And structural policies can tackle these underlying forces in many ways, in particular through better health, education, favoring on-the-job training, and also more in general by fostering equal opportunities. At the same time, next slide, as this graph shows, fiscal policy has a substantial power in offsetting the impact of structural forces. Inequality that is measured here by the Gini coefficient is significantly lower after fiscal policy has implemented its tax and transfer policies than before. And here you can see it because the red bars are higher than the blue bars. Next slide. Also, fiscal policy is powerful because the different fiscal tools can be easily targeted to different segments of the income distribution, and they can be used to achieve the desired outcome. Now, on the revenue side, you can think that progressive taxation, which imposes higher tax on higher income households, can reduce after-tax income inequality. And also taxes on wealth or inheritance can also reduce after-tax wealth inequality. On the expenditure side, governments can direct public transfers to specific segments of the population and therefore affect their disposable income and inequality. And here, the left-hand panel shows that progressivity has declined for a number of advanced economies, where progressivity here is plotted with the red line. At the same time, the share of transfers over GDP has increased, particularly during the GFC, and has remained at the higher level since then, the blue line. Now, the center panel shows that tax progressivity is negatively related with the income inequality at the top of the income distribution. Here, the top is the top 90 over the top 50% of earners. And lower progressivity is seen to increase inequality or to be associated with an increase in inequality at the top of the income distribution. And the right-hand panel instead shows that the higher share of transfers of GDP is associated with a lower income inequality at the bottom of the distribution. So overall, it seems that the variety of fiscal tools that are available to governments give them scope to address inequality that arises from different segments of the income distribution and to achieve the desired outcome. So let me conclude, next slide, by wrapping up some key conclusions. First, monetary policy does not seem to have the responsibility nor the tools to address structural inequality over the long run. Structural policies are essential to tackle this challenge. At the same time, by pursuing their mandates effectively, central banks and monetary policy can do a lot to reduce the macroeconomic forces that tend to amplify inequality over the business cycle. Changes in inequality also feed back into the transmission of monetary policy and its conduct, and reduce the effectiveness of monetary policy, therefore requiring more accommodative stances with possible adverse short-run consequences for wealth inequality. And this highlights the need to put together and to implement a more holistic framework that combines monetary, fiscal, and macroprudential policies. Thank you.
Thank you, Fiorella. You already showed a field where both monetary and fiscal policy may interact, calling for what you call a holistic framework. And I think this is exactly where Leonardo now comes in to give your views on the interactions between monetary and fiscal policies. Leonardo, very good to have you here. The floor is yours.
Thank you, Ernest. It's a pleasure to be here. With such great speakers, and this is a very nice conference. So I'm going to talk about monetary and fiscal policy interaction from the perspective, and I try to focus on the challenge for the central bank in the monetary union when fiscal imbalance are large and growing, and the real interest rates are low. And I'll try to share with you some reflection I have about a possible way to write down the monetary and fiscal framework for the euro area, which I hope we will solicit discussion and comments. So this is my talk. Is based on a paper I have with Francesco Bianchi of Johns Hopkins University and Anna Rogantini-Pico of Riksbank. And the disclaimer is that the views of this paper, what I'm going to present today, is solely mine and should not be interpreted the views of the Federal Reserve Bank of Chicago or any other person associated with the Federal Reserve System. This is this workshop with the Anna Rogantini-Pico of the Riksbank. It shouldn't be considered as the Riksbank. So, where does the euro area stand? So there are several countries in the euro area that now have elevated debt. So since the start of the great financial crisis, the debt in the more countries in the euro area now qualifies as a high debt countries. As if, for example, France and Portugal, also Spain, they were considered like small country with relatively low debt. Now they join the club of the high debt countries in the euro area. So this is going to require fiscal adjustment going forward. There will be a drag on economic recovery in the high debt countries. But also, since the euro area is very integrated, it's going to have an effect on the economic performance of the euro area as a whole. On the other hand, if you look at the monetary policy space, you can look at a very crude estimate of the space of monetary policy space in the euro area, by the way, many other economic area in the world. So, but we're looking at the euro area here. So this is the term structure I got from the website of the European Central Bank. So the blue line is the yield curve before the pandemic started. So the economy was kind of like in U shape, and you can see that at 10 years rate was positive, but was probably 30 basis points. So they limit substantially the ability, even with QE or forward guidance, for the European Central Bank to stimulate the economy if a recession happens. And the recession happened, with the pandemic, and you can see that in the darkest day of the pandemic, the green line, you can see basically then you can see that the yield curve was entirely in the negative territory, and because this is a reflection of the low nominal interest rate. And recently I took this yield curve of last week, basically October 11, 2021. You can see that we are halfway between where we were at the beginning of the pandemic and where we were at the darkest day of the pandemic recession. So again, bottom line here is that there is very limited space for the ECB to stabilize the economy recession, and on top of that, is the low inflation environment. Right, that sparked a lot of debate recently in the euro area, and perhaps also triggered the view of the framework of the ECB inflation has been low and they've been running below 2%. It has been particularly low and seems to have a drift down, not only in the euro area, but in the selected sector. And of course, in the past, the situation was very different. We came from a situation of very high inflation that warranted strict fiscal rules. In standard macroeconomic models, I mean, the central banks need to be able to control inflation, needs to have fiscal authority to follow fiscal discipline. This is even more complicated in this context like the euro area, in which you have multiple governments and one central bank. So there was really a need to restrain the national government. And my point is that there are going to still be the need to restrain, to put fiscal rules on national governments, but with a little tweak. So the situation now is that if I summarize what I said in the previous slide, so we have limits on monetary policy and combined with strict fiscal rules that basically leave no stabilization to high debt countries. Okay, so it means that high debt countries, which as I show are a larger set of countries right now, including France, Spain, Portugal, they basically have very limited ability to stabilize the economy in recession. Monetary policies of the ECB is very constrained, as I showed you before, and also they have large public debt. They need to adjust. They need to adjust they need to make the necessary fiscal adjustment to lower the debt. So this is an issue, and because it can generate a more polarized political economy. That's my main concern in the situation. So, and as I'm going to show you, have time also the lack of stabilization tools in the high debt country is not, it should be a concern also for low debt country, because again, the euro area is very integrated. So these require fiscal adjustment, and in the absence of sufficiently stimulating monetary policy, can generate negative spillovers on economic performance of the low debt countries. So my point is that now the euro area policymakers are at a crossroad. The challenge comes from the low interest rate, rising number of other countries. So I think that one of the important objectives here is to ensure the adequate macroeconomic stabilization to the euro area economy, and to mitigate the political polarization by ensuring that high debt countries are not left with no stabilization tools. On the other hand, low debt countries are not called to be responsible to repay debt they haven't issued. So my point is that given the low interest rate environment, the monetary policy framework is likely to keep us associated with these problems. And so this sparks some consideration about how we can design a new framework. So let's look at what the macro theory said about what to do in a low interest rate environment. So, well, in the low interest rate environment, you need to be able to raise inflation moderately in expansion. People call inflation overshoot. So when interest rates are low, ZLB constraints frequently binding. At the ZLB, you want to, that's Krugman and Eggerson and Wood for a very famous paper. They suggest that you optimal monetary policy prescribe lower for longer interest rates. You want to be more patient in raising rates and let it promise moderate increasing inflation. However, if you remember the graph, the graph for inflation in the euro area that I showed you before, but in many, even in the US, I mean, you understood that it's very hard to generate inflation. It's been very hard to generate inflation in a low interest rate environment. And there are different reasons. Maybe the risk of it in the ZLB, in parts, a negative bias to inflation. I don't want to go into details about the reason, but that seems to be like a situation in which we are living in. The central bank at least need to face. And so if you cannot generate inflation expansion, it's very hard when you are at the ZLB, credibly promising existing inflation. Okay, so then the important thing is that the new monetary and fiscal policy framework needs to be able to raise inflation moderately above the target in expansion, and potentially some inflation to bring monetary policy, to reinstate the role of monetary policy as a leading stabilization tool. And also the more asymmetric fiscal imbalances I hinted at the very beginning pose a new challenge to euro area policymakers. So in a sense, the low debt country are going to show in the paper with Francesco and Anna, we show that low debt country are kind of like a mirage of having fiscal room to weather the next recession. But the lack of stabilization tools in the high debt country takes a costly toll on countries, on low debt countries too. And in the side, the constrained monetary policy cannot mitigate the persisting headwinds to economic growth in low debt countries due to fiscal adjustment in the high debt countries. That's because, as I said, monetary policy, show you, 10-year horizon has 30 basis points room to stimulate the so that should be very concerning, the policymaker. And and also there is this the second challenge here is the political polarization. The new monetary and fiscal framework has to prioritize stable economic growth for European area countries. The required fiscal adjustment in the country is likely to be quite significant, and it's going to give rise to a persistent drag on the economic performance. And the high debt country will also likely to face deeper recession due to the lack of stabilization. So the Euro area policymakers have to alleviate the economic consequences of this fiscal adjustment for every country in the Euro area, and the macroeconomic stabilization should be guaranteed to every country after commercial. That's to fight the deterioration in the political polarization scenario. So the policy proposal, again, is, I would like to very eager to listen to your comments about this. So is rest on Eurobonds. The idea that we have is that you issue Eurobonds to combat recession affecting all EU countries, pretty much as has been done to fight the pandemic recession. And you don't give clear provision about how and when these Eurobonds will be repaid. What I mean by that is that you don't indicate a particular fiscal tools through which you tell the market when to repay the Eurobonds. And with the new monetary framework, as I said, the central bank needs to generate some moderate increase in inflation in expansion. And by these, the amount of inflation and expansion generated basically are be used to repay at least a share of these Eurobonds. And so in a sense, the presence of these Eurobonds make the lower for longer policy credible to generate inflation. Of course, at the national level, strict fiscal discipline, that's required, because we don't want that, low debt country be responsible to pay for welfare state for our debt issue by the high debt country. That would be unfair. Okay? But in the terms of the euro area, we have like a stock of bond, stock Eurobonds, not clear how they're going to be repaid. I mean, it's going to be fully like a fiscal gap. There is not going to be clear indication how it's going to be repaid. And the monetary framework, the European Central Bank decide what is the appropriate overshoot of inflation, now that he has adopted a symmetric inflation target. And then, the beliefs in the private sector will adjust to understand what's the fraction of Eurobonds that will be repaid through higher taxes that will be indicated going forward, or tax cuts in the euro area government, in the euro area countries, and how much of this will be repaid through higher inflation, which is the inflation that the central bank tolerates in expansion. The moderate increase in inflation that the European Central Bank like to tolerate. Okay, so this policy proposal is studied in a macro model, the general equilibrium model, and we have a two-country model of currency union. Market participants, as I said, form beliefs about what fraction of Eurobonds are fiscally unfunded. The larger the unfunded share, the larger the inflation needed to stabilize Eurobonds. And the new monetary framework plays a pivotal role in that coordinating. So this is not only in the model. I'm going to show it also. We have an estimate in the US that show that actually there is the point of the paper we show that part of the debt in the US is fiscally unfunded, or at least that's the belief of agents. And the role of the central bank in coordinating the share of unfunded debt is super important. It's very, very important. Yeah, it's very common to talk about that. But the new monetary policy framework plays a pivotal role in coordinating market beliefs about the share of Eurobonds that should be paid through higher taxes or higher inflation. And the answer would basically the framework pin down the share of fiscal, how much the central bank want to overshoot inflation, how much the inflation should overshoot the target of the ECB, pin down the share of fiscal and funded Eurobonds in the model. And the central bank must be clear, but set clear boundaries about how much overshooting in inflation is really being contemplated to avoid the return to the great inflation that here we are dancing with a very critical and risky boundaries. We don't want to go back to the 1970s either. So we want to, the central bank is very important to set a clear boundaries about what is an acceptable overshooting of inflation and expansion. So the model, I don't want to get detailed in the model. So we model the fiscal discipline as a national government responsible of the debts, Euro area fiscal authority fiscally responsible of Eurobonds. The Eurobonds will be paid through higher taxes or lower expenditure in the Euro area, and there are different details. Doesn't matter if it's going to be like a prepaid through transfer from the national government to the Euro area, or the Euro area introduce some fiscal tools to repay the Eurobonds. For the model, politically I understand it matters, but for the model per se, it doesn't matter very much. And the monetary authority is always active, so always follow the principle, always fighting all inflationary pressure in a very forceful way. It will be very proactive on inflation. And the alternative is that we call emergency budget rules. Again, national fiscal authority are responsible for the debt. The Euro area fiscal authority does not stabilize Eurobonds due to a particular shock. The model is based on a shock that generates a recession, plausible recession, we argue. And the monetary authority accommodates Eurobonds due to the shock. So it means that the monetary authority responds strongly to inflation generated by all other shock or business cycle shock, but not to the inflation that is necessary to repay the desired share of the Eurobond. And the desired share of Eurobond should be repaid, not repaid by taxes. Calibration is standard. I want to move on. I want to just show a couple of points here. I'm running out of time. So, so first of all, do we need a monetary fiscal framework? I think I already showed the limits the policymaker in the Euro area are facing. But also in terms of the model, more quantitative, I want to show you that when monetary policy is unconstrained, it can be effective to use a stabilization tool. This is the higher country output, low that country output. Here you have the Euro area output, and here you have the Euro area nominal interest rate. So when monetary zone is unconstrained, so and debt are kind of asymmetric, every country has the same debt. The stabilization works relatively well. You can see that the initial shock of that matter. Now I introduce a difference I introduce this purple line here, in which you have asymmetric debt. So I assume that one country has a high debt, calibrated to the Italy's government debt, and the other country has a steady state. Basically, assume that this is the German stock of debt. And then you can see already that when there is a recession, you can see that the dynamics of output in both countries is, in particular the other countries, is worse, worsens because of this asymmetry. If you do the ZLB, you can see now the central bank cannot lower interest in negative territory here on the bottom right graph. Then the recession will become even worse. So asymmetric debts plus ZLB creates this lack of stabilization, in particular for the other countries. But you can see there are effects also in the lower country as well. So the third scenario is the scenario we're studying. So it's the framework that we are suggesting, we are studying in this paper. And you don't even go at the ZLB when you have this recession. You can see the interest is not constrained because you generate enough, you are able to promise enough inflation after the recession that the central bank doesn't have to be constrained. And the performance in output and for both the high debt country and the low debt country is essentially there. I want to skip this part because we have time. I want to just point to perhaps the fact that this emergency budget approach also help to reduce this. Again, you start the model with different level of debt for the high debt country and low debt country. You can call this Italy on the left and Germany on the right, and you can see that under the fiscal discipline, because the old monetary fiscal framework, it takes longer to adjust fiscal situations, whereas in the emergency budget situation improves better. And the reason is that this new framework is foster economic growth better than the other framework, more effective than the other framework. And that's the reason why high debt country, low debt country debt to GDP ratio converge much quicker. So who wins and loses? So the users say, okay, we introduce change the framework, there's going to be kind of the cost for the low debt country. But we don't find that evidence in the model. So here you can see the volatility of the euro area output inflation and the high debt country output and inflation and the low debt country output and inflation under the 4 scenarios, basically one in which you have the ZLB constraint, which is the scenario of low interest rate, which is the current environment in which the central banks operate. And when you have fiscal discipline, the old monetary framework, fiscal and monetary framework, and the new monetary policy framework that we are studying in this paper. And you can see that all the countries benefit. They've got lower volatility without any inflation. That hopefully mitigated the polarization that we observed in the recent years between the high and low debt country governments. And one thing is interesting in the model. I want to mention that even if you live in a high interest rate environment, so GLB is not constrained. I don't impose the GLB constraint in the model. Still, if you have an asymmetric distribution of debt, still is beneficial to have the Eurobonds proposal. Okay, so the big question here, and I'm going to conclude on that, is that are they threats to independence of central bank? As I said, this is a risky business. We're playing a very risky game, right? Because in a sense, when you bring in fiscal policy, you bring in fiscal policy, and it can be a risk that the fiscal dominance, as I said at the very beginning. What is the challenge? That potentially you switch. There is a regime switch, as I said, from monetary dominance to fiscal dominance. Okay, that's a possibility, and we need to make sure that there are rules and that prevent from this event, which would be catastrophic. So as I said, the new framework requires fiscal rule at the national level, pretty much as in before. While the decision of how much Eurobonds to issue pertains to the fiscal authorities, meaning that it depends on how deep the recession is. So if you have a very severe recession, a mild recession for the euro area, you decide how much Eurobonds to issue. But how much inflation to create out of the stock of Eurobonds is decided by the central bank. And that's so we're not proposing the central bank give a blank check. Okay, everything that the national government issue under their name or Eurobond should be that's not study here. So the only a fraction of this Eurobond will be fiscally funded, and the fraction is needed, is the amount needed to boost inflation and expansion as the central bank sees fit and consistent with its framework and objective. Remember, the central bank needs to generate inflation, some moderate increase in inflation in recession to be able to stabilize the economy. When we're going to go back to the ZLB, we live in a low interest rate environment, so every recession will trigger the ZLB. And when you are there, you need to promise high inflation in the future. You need to be credible. In order for this promise to be credible, you need to generate inflation expansion. So I don't have time to talk about this, but I have a paper with Francesco Bianchi and Renato Faccini of the Danish central bank, in which we show that for the US, the central bank plays a critical role in coordinating the release about the fraction of federal debt the market participants expect to be this kind of fund. Okay, so that's very reassuring that the central bank has very strong hold on this aspect. Let me wrap up. Deterioration of fiscal position put euro area countries at crossroads. Follow fiscal discipline, regardless of causes behind large fiscal imbalances, or reform monetary and fiscal framework. Possible overall of current monetary and fiscal framework resting on Eurobonds that we study in the paper with Francesco and Anna. And Eurobonds provide the European area with another stabilization tool to weather future recession. And Eurobonds allow to separate the need for short-term stabilization from the issue of long-term fiscal sustainability. It's the key component of this It allows the monetary authority to end the prolonged period of low inflation. We have time to show that, but we're going to see that. In doing so, to reinstate monetary policy as a lead stabilization to the euro area. And so.
Thank you very much, Leonardo. I think it has become clear that each of the three topics that we have addressed would easily cover a whole session or a whole conference. I nevertheless try to collect questions on all the three themes. I propose we start out with the theme of central banks and climate change. I have one question here in the chat, which reads, Anna noticed one severe problem on reporting, for instance, CO2 numbers. Actually, they are not measured at all and are just a goldmine for different consultancy firms. Could central banks or the BIS, and I think I could also direct this question in addition to Fiorella. So could central banks and or the BIS work in order to develop a database to be used by the whole industry so that all companies get the necessary data for the sustainability reports? This would make it much easier to get reliable data for banks in credit quality analysis of counterparties. Anna, Fiorella, what would be your take on this question?
Well, thank you. It's a very good question, and I can start. We do actually have good data on some companies. For some companies, for example, industrial companies that have certain types of production, say steel production, it's very high in carbon emissions, and we have very detailed data from that. We also have, in some countries already, carbon taxation. We have the European trading system. So for parts of the corporate universe, we do have good data. On national levels, we also have good data. But there is a problem with measurement for many types of firms. And I think the best way forward is actually to get mandatory disclosures and global standards for disclosures. And that is hopefully happening. There is work, I know, IOSCO, for example, and IFRS working on putting forward an international standard that then can be adopted by different countries and potentially also be made mandatory for corporates to disclose. So for some companies we have data, for some it's not at all good enough, and there is some international work ongoing that I think can provide a good way forward.
Fiorella, would you want to add something?
Yes, I think it's a great idea, and this kind of database would be very useful. It's certainly worth the effort of putting this data together. There is a lot of effort currently done by central banks, various central banks on disclosure, as Anna was mentioning as well, and so there is a basis for already collecting some information. Now the question is also harmonization of these different efforts done in different countries.
Thank you very much. If I may, I would like to follow up with you, Fiorella. Tell me if I got your messages wrong, but let me paraphrase what you said. So inflation hits the poor more severely, but so do recessions. They also hit the poor more severely. So both types of monetary policy mistakes, if we take the current situation, withdrawing the expansionary stance too early, but also keeping it too long, would hit the poor particularly much. In the one case with a new recession, in the other case with too high inflation. Now, this also, of course, highlights the seriousness of one scenario that is currently painted by some observers of stagflation, which brings both a recession and higher inflation. So what is your conclusion or your advice based on this?
Thank you. This is a great question. So there is a trade-off between recession and inflation, as you point out, but I think it's less severe in advanced economies, or at least in countries that are characterized by low inflation. So the type of evidence that I was showing pointed to a large impact of inflation on the poor, so particularly when inflation is already high, and particularly in emerging markets. In advanced economies, this evidence doesn't seem to be large. There is rather another trade-off that is very interesting and arises with prolonged expansionary policies. The fact that prolonged expansionary policies tend to, reduce recessions and therefore, benefit the low-income segment of the population. At the same time, these increases tend to increase asset prices, and so tend to penalize low wealth segments of the distribution. So the trade-off that I see more relevant for advanced economies, at least, is between income and wealth inequality. But I think that the wealth inequality can be, a short-term side effects of policies that tend to benefit the poorest via supporting their income and reducing recessions.
I have a couple of questions that have come in meanwhile. One is from Klaus from the ECB to Leonardo. Klaus says, this is a great paper. In another paper on the dire consequences of a lack of money fiscal coordination, you suggest that inflation should generally be after bad shocks, that is, adverse shocks which increase public debt, and lower in good times. Here you make a similar suggestion related to the zero lower bound. Do you think that central banks should include generally such countercyclical inflation in their strategies?
This is a great question. So then I got time to go to the detail of the paper, but there's no paper. But yeah, so this strategy, so this suggestion can be like an automatic stabilizer. You can think like in every recession, the national government issue euro bonds to help national government to weather the recession. And the ECB is expected to inflate away part or a small share of these euro bonds as the ECB sees fit to achieve their goals. And in the sense, it doesn't have to be like a one-off policy just related to the euro bonds issue after the pandemic, but it can be like a strategy that is recurrently adopted. And in particular, I think one way, and that's how we are revising the paper now with Arne and Francesco, we are thinking about a situation in which all the time with the ZLB, okay, you're going to generate euro bonds, and the share of this euro bond that will be repaid through higher inflation, modeling higher inflation, is basically depends on the severity of the recession. So that's what we have in the direct effect of lack of coordination paper, in a sense. But there was not the ZLB. So there was like a big shock, as Aaron said, as Klaus said. Basically, you have basically a big recession, and then you're gonna generate enough debt, and you're gonna generate enough inflation to stimulate the economy out of this recession. The other idea would be more like the ZLB, and the persistent the ZLB tells you how severe is the recession. That will tell you how many euro bonds you'll be issued, and how much euro bonds the central bank will use to boost inflation in the future. In the model, we don't have euro bonds issued for other reasons. So the only euro bonds issued are the euro bonds that the central bank want to inflate away. In reality, it may be more complicated than that. Maybe national government want to larger stock of euro bonds, and the European Central Bank just target a small fraction of it. That's what I see going forward. In the model, we can introduce this automatic stabilizer thing. It would be very useful because as you see a recession, you already anticipate, the private sector already anticipate how the central bank will react, how much inflation will generate in the future. And that would be consider as an automatic stabilizer, as I said, so useful.
Thank you. I have a question here from Oreste Tristani to Fiorella, but I think it might also be relevant for Anna for the Swedish case. And the question is, do you think that inequality could play a role in guiding the choice between different monetary policy instruments to the extent that they produce different side effects on different groups in the population? So the question is, I mean, to my knowledge, this seems not to have been a major consideration so far, but it's more the effectiveness on the macroeconomy that has been the guiding principle. So what is your view on this, Fiorella, and has this been a consideration in the case of the Riksbank when employing different instruments?
Yes, thank you, Oreste. That's a great question. Yeah, of course. I mean, there are different implications of the use of different monetary policy tools on the various segments of the population. Even the same tool, as I was already mentioned before, can have a very different implication. Expansionary monetary policy through lower interest rate can help the low-income segments of the population through their supporting activity and therefore their wages. But it can also have intergenerational implications. For instance, a low interest rate that tends to increase asset prices and house prices, and this tend to favor the old generations who are the owners of houses relative to the young generations who typically do not yet own and need to buy new houses. Similarly, if you think about balance sheet policy, you can really target the various measures, the various type of asset purchases to the segments of the population that are suffering. We saw that during the COVID crisis, all the balance sheet policies were aimed at supporting the economy, but also the workers that were laid off temporarily because of this common negative shock. So it is very similar to what I was saying about fiscal policy. You can have these different instruments and you can target them to obtain a certain outcome in terms of a distribution. But should you do that while governments is really their turf and their aim should be to affect distribution, that's not clear that this should be what central banks care about.
Anna, what is your take on this question?
Well, it's a great question, first of all. And I can say that the pandemic is an interesting example. We did only look at the effectiveness of the instrument when we chose which instruments to use during the pandemic. We did not lower the repo rate, which is our main policy rate. We only used balance sheet tools because we assessed that during this type of crisis, they were the most efficient to help us reduce the negative effects of the crisis and also prepare the economy to have a strong recovery when the pandemic started to be over. Like, I don't want to say it's over because it's not at all over, but we're seeing a recovery now when the effects of the pandemic is smaller. Normally, and I think that's correct, it is fiscal policy that have both the most efficient and the best tools to deal with income inequality. During this crisis, also very clear that in Sweden, fiscal policy did a lot of targeted measure towards the households and towards the firms that were the most affected by this crisis, because it was very uneven in terms of the effects it had on different households and different firms, while our policies were aimed to support all firms and all households through keeping interest rates low and to keep the transmission working through the economy.
Thank you very much. So if I may summarize your remarks by the two of you. So monetary policy admittedly has distributional effects, and different monetary policy tools may have different distributional effects. But what mostly guides monetary policy decisions is the overall efficiency of the policy for the macroeconomy. And fiscal policy is much better equipped to target specific groups of the population and to deal with distributional effects and to dampen them and to cushion them. I have a question here for Leonardo. which is, does your proposal require a new common fiscal institution to decide when the common emergency budget is to be used? That could be politically very hard.
It does not. Okay, it doesn't need to have. The important thing for the proposal to work is that this is not the central bank doesn't give a blank check to national governments. That's key. So it's not like potentially, if you have an institution, which I agree with Oreste, is very hard to build in the euro area, to decide how much euro wants to issue. That will be more efficient, perhaps, in the wake of a recession, like the pandemic was very abrupt and hit the economy strongly and abruptly. That may be ideal, but not for the proposal I'm studying with Anna and Francesco. That's not essential. The essential thing is that it's clear that Eurobonds doesn't mean inflation. It means the central banks use Eurobonds to generate inflation expectation going forward. In the absence of Eurobonds, this is going to be harder to generate sufficiently high inflation expectation to stabilize the economy at the TLB. That's it. But the amount of Eurobonds that should be used to generate enough inflation going forward has to be decided by the monetary authority. That's clear.
Leonardo, you mentioned the topic of central bank independence at the end of your talk, and I think all three topics sort of touch upon the issue of mission creep. So, more and more effects of monetary policy are identified, and central bank mandates are directly or indirectly charged with more and more, goals, and the question of mission creep and of blurring of responsibilities emerges. These multiple objectives also emphasize the need for policy coordination, which is strongly increasing, let's say over the past 15 years, but more so even over the past 2 years since the COVID crisis. Now, my question to all three of you, does this imply that the notion of independent central banks which operate within a narrowly defined mandate, the achievement of which can be easily monitored, becomes less relevant, obsolete, or de facto even impossible? So is central bank independence in this new environment obsolete? Is it still possible? Is it less relevant? I don't know who wants to start. Very big question. Yes, Anna, please.
Oh, but it's a great question. And I have to say, first of all, I don't think the central bank's independence is in any way less relevant. And we are extremely careful when we communicate. And it is very difficult when you communicate regarding these issues to stress that our primary mandate is price stability. And we will not go away from that mandate in any way. When we talk about on the margin, mitigating climate change, I have to be very clear. We don't think that we can in any way substitute the first best policy response, and the responsibility that lies with governments. Fiscal policies and taxes, investments and other things are the most efficient tools when it comes to mitigating climate change. What we do is to, on the margin, complement those tools, and also doing what we are obliged to do, which is to consider risks. And climate change does pose risks to the assets that we have on our balance sheets, and therefore we have to act. That's how we read it. So we are very, I hope, we're very clear that price stability is our primary mandate. We're very careful in exactly how we design our policies, so we keep within our mandate and within the legal framework. It's not mission creeps, and independence is in no way irrelevant.
Thank you. Fiorella, what's your take? What does the BIS, the Central Bank of Central Banks, say?
No, I think that central bank independence is as alive, as important as ever, or even more. And central banks are certainly aware of that. And I think I agree with Anna in the sense that the mandates of central banks are placing a very important and very clear perimeter, and that's also why coordination has become so crucial, because each institution has to coordinate, has to communicate and coordinate within the remit of its own mandates, which for each institution differ. So coordination really comes because there is this perception that the boundaries of the own mandates have to be kept very, very clear, and that's the way to go forward, I think.
Yeah, I agree with both Anna and Fiorella, but one quick qualification I'd like to make is that the low interest rate environment and the large debt should spark a rethinking about whether independence means unconditional separation of the monetary and fiscal policy. I think that we should discuss whether it's still ideal, it still serve well the purpose of a bigger economic area like the euro area, or having some interaction with the monetary fiscal policy, respecting the independence of the central banks and the goals of each of these two authorities is ideal for achieving macroeconomic stability and to prosperity in the euro area. So central bank independence is a value. There is no doubt about that. It's super important. The central bank has the primary goal of stabilizing inflation, as Anna said. Maybe we should talk about just separate concepts. Independence of the central bank should be there. An independent concept is like, do we want to stick with unconditional separation between monetary and fiscal policy at the time? That's a little bit, I think, a discussion that would be interesting to have. And it's research show that the research I've done with Anna and other economists that show that may not be this unconditional separation in monetary and fiscal policy may not be ideal. With that being said, central bank independence is critical for all the outcomes, the positive outcomes I illustrated about this idea of emergency budget or any other form of interaction between monetary and fiscal policy.
Thank you very much, Anna, Fiorella, and Leonardo, for sharing your views with us. I think this was a very interesting session because it brought together three very topical themes that are all very urgent right now. And I think that central banks' tasks in a changing world, as you have shown, it puts many challenges to central banks, but it does not basically rock the foundations of our thinking of central banking to be done by independent central banks, although there might not be, that issue might not be as black and white as one might sometimes think, but maybe it's more some shades of gray. Let's now have a coffee break and reconvene at 4 o'clock sharp for the final panel on experiences from central banks' strategy reviews. Tuomas Välimäki from the Bank of Finland's board will chair. Philip Lane, ECB's chief economist, Andrew Levin, and Patricia Mossa, two famous professors, will join the panel. So let's be back at 4 o'clock. Thank you very much. See you in a few minutes. Bye-bye.
Thank you. Thank you.
Hello, good morning, good afternoon, good evening, depending on your location. It's a great pleasure to me to moderate the final session of the great workshop we are having on comparative appraisal of monetary policy approaches. The SUERF conferences and workshops normally try to get researchers and practitioners sitting together around the table. This is certainly the case for workshops like this that we are having now. Yet in this panel on experiences from central banks' strategy reviews, we have taken this approach one step further. We have not put up a panel with some researchers discussing with some practitioners, but each and every participant in this panel has had a distinguished career, both as a central banker and in the academic world. The first panelist in this final session of today's workshop is Andrew Levin. Andy works as a professor of economics at Dartmouth College, where he teaches macroeconomics and monetary policy. Andy has published numerous articles on monetary policy strategy and the dynamics of inflation. Before working as a research fellow and advisor at the IMF, he served 20 years at the Federal Reserve Board, including 2 years as the special advisor to the chair and vice chair on monetary policy strategy and communications. In January 2009, in the height of the financial crisis, I remember we organized a workshop in Helsinki on the making of monetary policy close to the zero lower bound. And he was a key member of the organizing committee that set up an excellent collection of research and analysis on that topic. How to navigate through the uncharted waters, how to switch from conventional to unconventional monetary policy, where the role of balance sheet management had to expand as the setting of short-term policy rates was no longer sufficient. The lessons from those days must have still been in the back of policymakers' minds when going through the strategy reviews of some 10 years later. Our second panelist is Patricia Moser. Patricia is the director of the MPA program in Economic Policy Management at Columbia University School of International and Public Affairs. She also leads the school's initiative on central banking and financial policy. In short, Patricia is responsible for training future ministers and central bank governors. Lately, Patricia has written numerous pieces on financial stability and monetary policy topics, including financial reform, crisis policy tools, cyber risks to financial stability, and the monetary transmission mechanism. Previously, Patricia had been the head of research and analysis at the US Treasury Office of Financial Research, and like Andy, Patricia spent over 20 years in various positions at the Fed, mostly in its operating arm, the Reserve Bank of New York. In 2009, in the height of the financial crisis, Patricia was SOMA manager for the FOMC. Patricia, if anyone, really knows how to implement monetary policy and how to build an operational framework that functions under all circumstances. The third panelist in this session also has a distinguished career both as a central banker as well as in academia. Before becoming the governor of the Central Bank of Ireland in 2015, Philip Lane served as a professor of international macroeconomics and as Waitley Professor of Political Economy at the Trinity College. In 2004, Philip was one of the external evaluators for the Bank of Finland research function. That time we got two important recommendations that I remember well and to which later on the bank has acted upon. First, in line with the recommendation, our research function consists currently of PhD economists with permanent or very long-term positions, instead of being a place for policy economists to take their sabbatical leaves. Second, our research is now mostly being published in by far higher quality journals than used to be the case some 15 years ago. I'm grateful to you, Philip, for these recommendations. Our research has greatly benefited from them, but there is another lesson to learn. According to the examples by Philip and Loretta by then, you are likely to become a central bank governor or president if you say yes to our invitation to be an external evaluator. Please keep that in mind in the future if we approach you. Now, I'm sure that we all agree that as the chief economist of the ECB, Philip is by far the best person to guide us through the experiences of the ECB's strategy review that was finalized in July. Now, before giving the floor to the panelists, let me briefly motivate why we at the Bank of Finland considered already quite a few years ago that it would be due time for a monetary policy strategy review. A well-functioning strategy is transparent and credible. If you wish to anchor inflation expectations, people need to understand what your inflation target is, how you try to achieve it, and believe that you are willing and capable doing what is needed to get there. So firstly, if you want to provide the markets and the real economy with a focal point for the inflation expectations, your aim should be uniquely defined. The double key definition with the price stability being fulfilled with inflation below 2%, together with an aim to have it close to 2%, was hardly uniquely defined nor symmetric. Empirical research done here at the Bank of Finland indicated that either the ECB was having asymmetric preferences around 2%, or the preferences were symmetric, but at a level closer to 1.5 than to 2%. Having grown up in Finland in the 70s, I should be tempted to say, who cares if inflation is 1.5 or 2%? But it does matter. It does if the effective target is different from the outstated. If the public believes we are aiming at 2%, but we systematically produce 1.5, the real rates will be constantly too high. Furthermore, in a currency area setting, if people in one country, say Germany, for example, form their expectations around 1%, whereas in other countries around 2%, it can result in cumulative price developments that have nothing to do with the productivity differences between the countries. To put in a nutshell, it's easier to influence inflation expectations if you have a unique target and you communicate it explicitly to the outside world. But the strategy is not only about the definition of price stability. Also, the central bank's reaction function matters. That is, the way one tries to achieve her goal is important. The more so if the interest rate space is limited. When the ECB strategy was formulated around the millennium, one thought that 2 + 2 = 4. That is, the natural rate or the equilibrium rate is some 2.5%, and inflation is close to 2. The nominal rate is on average some 4%. And the ECB has considerable leeway to boost demand in a downturn. Now, this is certainly not the case if the equilibrium rate is closer to 0, or the more so if it becomes negative. In such a case, zero lower bound puts a real and effective limit for the use of interest rates to boost economic developments. Simply, our traditional toolbox has become asymmetric. Now, if we are less efficient in bringing inflation back to 2% from below than when coming from above, the long-run expectations are likely to fall below the target unless the problem is otherwise addressed. The initial approach applied by central banks worldwide seems to resort to unconventional policies like quantitative easing. However, lately also another approach has gained popularity. If you produce less inflation than you aim at due to the asymmetries in the interest rate policy, you could compensate for this bias by temporarily overshooting your target. An approach that David Reifschneider and John Williams originally labeled as temporary price level targeting, but has lately been referred to as make-up strategy. Now, I only referred to a few of the many elements that we're calling for strategy review. There are certainly much more of them, and probably even more important: monetary fiscal interactions, climate change related issues, communication aspects, to name a few. I now let Andy, Patricia, and Philip to give their initial thoughts on the recently conducted monetary policy reviews in the US, as well as here by the Eurosystem. So Andy, first, the floor is yours.
Well, first of all, thank you so much to the Bank of Finland and SUERF for organizing and hosting this workshop, and really great to be here with you. I think sometimes opening a panel is sort of risky exercise. The good news for me is I feel like I have a safety net, because if I say anything silly, then I know that Trish Mosser and Philip will come to the rescue and clarify and clear the air. So let me, I think the idea is for me to start out with some broad perspective, really drawing partly on the framework renewal here in the United States, but also looking at other central banks around the world. I think the basic premise of a framework renewal that happens on a regular basis, maybe every 4 or 5 years, seems reasonable. That's something the Bank of Canada was really the pioneer in, and I think they should be applauded for having started to do this, and really set an example and a role model for many other central banks around the world that are starting to follow this approach. what I noticed when I worked at central banks and visited lots of central banks, central banking culture tends to be very insular. It's tradition probably that goes back 100 years or more. And so this kind of framework renewal is really an opportunity to reach out and to hear different perspectives and to ask harder questions, to think outside the box. It's not easy to do that. Just to give you an example of this, the Federal Reserve's initiative was called The Fed Listens, but still it's hard. It's the easiest thing to do is just to listen to your friends and the people that know you and you can trust. When the Federal Reserve had its major landmark conference at the Chicago Fed in June of 2019, I think there were 150 participants, and if my recollection is that all but 5 were either current or former Fed officials and staff. So the challenge in really trying to listen and get new ideas and fresh perspective is a really critical part of this. I think another thing that's important here is the central banks do not have autonomy. When we talk about central bank independence, we should be clear here. The central bank is accountable to elected officials and to the public. And so part of the purpose of having a framework renewal is to ask the stakeholders, how can we do a better job? How can we serve you better? And so I think some of that could potentially involve legal changes that need to happen that would have to be done by the elected officials, but where the central bank itself is recognizing the need and the rationale for making those changes and engaging on those discussions with elected officials and the public. So again, a broad-based, inclusive exercise seems really critical. Just to delve a little more specifically into some of the specific issues, one question here that it's already been raised throughout this workshop today is how can central banks mitigate the effect of lower bound on monetary policy? And one approach for that, which the Federal Reserve decided to adopt, is average inflation targeting. I think that approach actually seemed very sensible in a situation where it looked like the US economy was going to have a repeat of the last 10 years with inflation continuing to run low on the low side and assuring the public that the Fed would tolerate some moderate overshooting. It turned out, however, that it was not well designed for the situation we're actually in today. And so I just did a few calculations before. If you look at the current inflation rate for this year is running above 4%, the PCE price index that the Fed looks at. I think a reasonable scenario is that next year inflation comes down to 3%. It could be lower than that, it could be higher than that, but just say 3%. If that's true, then the 5-year average for inflation as of next year is going to be about 2.4%, which means it's well above the average inflation target. And the problem that puts the Fed in is if they're serious about continuing the AIT, they have to promise that they're going to bring inflation below 2% over subsequent years. And of course, that could require an abrupt slowdown in the economy. It would require inflation going below 2%. That seems politically untenable. So probably pretty soon, it could happen in January, it could happen the following January, the Federal Reserve is going to have to change again. Not to wait for 5 years, they're going to probably have to change again and backtrack to some degree away from the AIT that they adopted. And part of the reason, again, I think is because when they were creating the AIT, they weren't listening to enough outside people, including outside experts and others, raising questions about risk to the outlook and things that could go wrong. Another thing I want to emphasize here, because the central bank, its most critical role is price stability. No question about it. The central bank's the only agency that has that responsibility. But we understand, some economists call it flexible inflation targeting. Others refer to a dual mandate or dual objectives. The critical thing here, I think we all agree on, is the central bank, in the process of promoting price stability, is looking at broader measures of social well-being, including employment and disparities across groups, and recognizing that its policies have differential effects across groups. And so in the process of fostering price stability, whether it's the ECB or the Fed or the Bank of Canada or the Bank of Australia, whatever you name it, thinking more broadly, and then explain clearly to the public and to elected officials to whom it's accountable how it's promoting those broader measures of social well-being in the context of fostering price stability. Now, with respect to the Fed itself, the new framework has now acknowledged that maximum employment is a broad-based and inclusive goal, but they didn't quantify what that means. So it's left very vague, and I think that leaves the Fed open to criticism. The worst case for the Federal Reserve is to have a framework that really undermines its operational independence. The ideal is to have accountability and transparency that strengthens and preserves the operational independence. I think that's a key purpose for doing these framework renewals. The last thing I'll just raise here is I think central banks have been too focused on emphasizing a modal outlook, a baseline outlook. And what we really need to move to soon is something that recognizes risk to the outlook, talks about those specifically, and that talks about alternative scenarios and contingency planning. What's the path of policy if one of these risks materializes? Doctors do this with their patients. Meteorologists do it when they do weather forecasts, even things like a hurricane that are quite alarming. They look at the range of possible outcomes and help people to be prepared for those. Central banks do this with stress tests, for at least some central banks do it with stress tests for financial supervision and regulation. This should become part of our standard monetary policy, again, both the decision making and the communications. So again, I appreciate the safety net. Now we get to hear from Trish and Philip and all their common sense and wisdom. So I'll be quiet and listen now myself. Thank you so much.
Thank you, Andy. And let's move right to you, Patricia.
So good morning, good afternoon, everybody. I want to thank the Bank of Finland and SUERF for inviting me to do this. It's a real pleasure. I'm going to follow up Andy's comments with a few practical central banker observations about, particularly about FATE and related issues. So the flexible average inflation targeting, the Fed's new framework. But I particularly want to focus on how this might work or not work in the current macro and financial environment. Let me say at the onset that I'm somewhat more sympathetically inclined ex ante toward average inflation targeting than Andy is. But the current environment is incredibly challenging for implementing it. So let me back up for a second and before I get to that and start with two obvious statements, but they're worth saying anyway. The first is that in the last 6 months, the global economy and the US in particular has finally experienced COVID's aggregate supply shock. And the price spikes and the supply disruptions that we've seen, of course, were exacerbated by the massive fiscal stimulus in the US, causing a fast and early and large rebound in the US. And compared to the unevenness of the rest of the global recovery from the pandemic, it has made all of those supply issues obviously worse. Second obvious statement, supply shocks are really tricky for central banks to handle. They're really tricky to handle even when the central bank has a well-established inflation targeting framework that it has been used and tested by experience over time. Now, if you're a central bank that has that sort of a framework, then what to do with temporary supply shocks or transitory, that's the latest favorite term of art, of course, is actually short-term accommodation is what you ought to do. Keep monetary policy loose, let prices go up temporarily, prevent growth from deteriorating too much is the right call. The Fed doesn't have that right now. What the Fed has done inadvertently is to introduce a new and untested monetary policy framework in the wake of the largest and potentially the most persistent supply shocks in 50 years. And combined with what has been, for the last 2 years, the largest fiscal policy stimulus since the Second World War. that's like way out there in the tail. So if you could take what I've just said as reinforcement of my agreement with Andy that thinking a lot more about how things behave in the tail events, things that are outside of our everyday experience seems pretty important. Now, I mentioned I'm more sympathetic in theory, toward the Fed's new framework, perhaps than Andy is. And I do have to say that a core reason for that is that it explicitly requires the FOMC to look in much more detail at the state of the labor market. The Fed has a dual mandate for better or worse, but the way the central bank can go about that historically has frankly been kind of simplistic, at least with respect to their communication. I'm not going to say that inside the Fed, they weren't looking at things well beyond that. But they're thinking about what full employment means as is a very subtle policy problem for a central bank, and one the Fed is required by law to tackle directly. And I think the new inflation targeting regime that they're explicit and they communicate about it explicitly and they talk about the indicators is a huge step forward. But I'm also sympathetic to the idea of at least considering average inflation, or if you like, price level targeting, for a couple of reasons. Again, fairly practical reasons. The first one is, to be blunt, inflation targets for advanced economies, practically speaking, are ceilings. They are not targets. Now, the ECB, to their credit, has been clear until their recent review that it was a ceiling. That was they didn't want to go over 2%. But the other central banks were not. But as a practical matter, they were ceilings. Let me put it this way: the Fed tolerated missing its inflation target 40 basis points every year on average for 12 consecutive years. They would have never allowed inflation to miss on the upside by 40 basis points every year for a dozen years. They wouldn't have. I'm very careful about predicting what the Fed will and will not do, but I'm quite confident in that statement. So one of the results of this, of course, has been, as we all know, that core inflation's been well below its target. And that peak policy rates during expansions are low. They're too low, and there's a lack of policy space the next time you have a downturn, which then leads us to use even more unconventional policies and in larger and larger size, huge balance sheets, and both the communication difficulty and bluntly the political risk for central banks seems to increase over time. I think that's dangerous, frankly, in my estimation. So let me take fate seriously for a minute, too seriously. I mentioned that the 40 basis points per year for the last 12 years is how much the Fed has missed to the downside on its inflation target. If you do the arithmetic, that's 5 percentage points of annual inflation that in theory they could, quote, make up. Now, let me pause and say, we know that the new framework does not have an explicit look back period, and I'm sure that the FOMC has no interest in ever probably doing such a thing. But like Andy, one of my questions is, how long is the FOMC going to use the new framework to let inflation run hot in the current circumstances? Here, actually, the Survey of Economic Projections, which means the FOMC's own forecast, might be helpful. Right now, in the numbers that the projections that came out in September, came out a few weeks ago, pardon me, say that the FOMC could live with about 2.2% inflation for several years, not this year, obviously the number's going to be much higher, and only slowly raise rates in response to that, suggesting, at least in the very short run, they're more worried about labor markets than they are about inflation. But the question becomes that the aggregate supply shocks are persistent. And I actually think there's a decent chance they will be, for one thing, because the needed structural adjustments in labor markets everywhere seems to me to be quite large. How long are the Fed and other central banks going to tolerate inflation not being a little above target, not 2.2% inflation for 3 years, but way above it? So that's my concern, in other words, is very similar to Andy's. The bottom line in all of this is that the addition of new policy frameworks has unfortunately created a very high level of uncertainty. And I mean, by that, I mean Knightian uncertainty. Obviously, the pandemic itself has created huge amounts of uncertainty. And so the path of the economy, regardless of the stance or framework or monetary policy, as we have all learned to our peril, is in the virus's hands. And economic policy just has to come in afterwards and try to keep the devastation to a moderate amount. But you add to that the uncertainty that these new policy frameworks and how they're going to be used in the face of continued supply disruptions is a question. The Fed's credibility right now that they can pull it off remains pretty high, particularly in financial markets. And I guess the good news for the Fed is there not a lot of uncertainty in the very near term, either amongst the policymakers themselves or in the financial markets. The Fed's reaction function for tapering seems a relatively done deal. Barring some sort of macroeconomic disaster, the Fed is going to start tapering bond purchases in November, and they'll finish next summer. But beyond that, the uncertainty about their reaction function is high. They're probably going to raise rates perhaps once in 2022. There's a fair amount of consensus about that. But there is no consensus at all on the FOMC right now about what they're going to do in 2023 or 2024. It's literally the responses of the FOMC members and participants is all over the map. In 2023, estimates of the end of the year target rate is from 25 to 50 basis points to 2%, and it's flat, evenly distributed across everything in between. In 2024, the estimates range from 50 basis points to 250 basis points. Again, very flat. Now, in theory, those differences could be disagreement, but I'm dubious it is disagreement. I actually think it's uncertainty. And the FOMCs, if the policymakers are that uncertain, it would not take much, unfortunately, I'm afraid, to make everybody else a lot more uncertain as well. So I'll stop there and turn it over to Philip. Thank you.
Thanks, Patricia. And now to you, Philip.
Okay, thank you, Thomas, and thank you to the Bank of Finland for organising. Now, I think this was organised a long time ago to have this event, but in the knowledge that we would have not just the Fed review that came out over a year ago, but the ECB would have its review. And so having this comparative analysis made sense. And, I think I haven't quite participated in anything like the format today. Now, of course, as is obvious, we also have important differences right now, not only in terms of strategy framework, but in terms of the conjunctural situation facing the US versus facing the euro area. Let me, by the way, endorse a lot of what Andy said about how to run these reviews. Of course, we had to kind of, we were not the first mover. Of course, the Bank of Canada had regular reviews. The Fed went ahead of us. And of course, we had our own history from 20 years ago. But very much, let me emphasize that we did try to run this as an open exercise. For example, it is very definitely a Eurosystem with all the 19 member central banks fully participating, as well as ECB staff. We had interesting roundtables with online roundtables given the pandemic with both academic economists, but actually in a very interesting way, academic lawyers as well, which is I found quite interesting. And of course, behind our review, which I think was very much behind the Fed review as well, what was how to think about a world where the equilibrium real rate had gone through a trend decline, and where, especially if you combine that with low inflation readings for a number of years, effective lower bound considerations. Patricia there and Andy was referring to the Fed decision about how to deal with that, which is flexible average inflation targeting. We ended up in, I think, a related response, but not quite the same. So very definitely, in our review, and Olli Rehn this morning in opening this event went through a lot of this, but very much in addition to, updating our inflation target to be a symmetric 2% target, we took on head first the implications of the lower bound, where we essentially committed that whenever the lower bound was a constraint, that we would adopt forceful or persistent policies. And by the way, even if this implied a temporary period of moderate overshooting. So I should say very much, and then we converted that into revised forward guidance later in July in relation to our policy rates. I should say, by the way, the way we wrote the revised forward guidance, and very definitely behind a lot of what we did in the review, was the issue about cost push shocks, supply shocks. Because in the history of the ECB, this, has been a very powerful issue that the ECB has confronted repeatedly. And, in the context of the euro area as a big net energy importer, with pretty big fluctuations in energy prices, what has unfolded now was definitely, one of the scenarios we wanted to take care of in preparing the strategy. Because of course, a strategy shouldn't last forever, but it should have at least 5 years in it, I think. So you want to be able to cover eventualities. So when we wrote the forward guidance, in implementing the strategy, we have basically 3 core conditions to be met before we would lift interest rates. One element was that we wanted to see inflation reaching 2% sufficiently early in our projection horizon. So that is there to guard against being over-reliant on uncertain forecasts, that that early in the projection horizon, we have more confidence in our projection than at the very end of the projection horizon, just given the nature of the timeline. Now, of course, in a situation where inflation is currently above 2, that condition is not the most discussed condition we face. But we had a second condition, is we also need to see reaching 2% be durable, that it remains at 2% for the rest of the projection horizon. So going back to whether we call it transitory, temporary, whatever language you want to use, in terms of our rate forward guidance, a pretty basic criterion is, do we foresee inflation remaining at 2% throughout the projection horizon? And given in our September forecast, which is not that long ago, we have inflation returning to 1.5 in 2023. That condition is not there. And then the third condition is, we also, given the uncertainty of life, don't want to just rely on forecasts. We also want to be taking account of what's actually happening, so the data dependence, where we wrote it in the context of underlying inflation. So we need to see sufficient progress in the realizations, i.e. the outcomes of underlying inflation, that we can be confident of reaching 2% in the medium term on a durable basis. And right now we have high headline inflation, but most of that, it is the energy prices, and then there's the pandemic-related reopening surge as well. So under those conditions, I mean, it really caters to provide an environment in which we can look through transitory supply or external shocks. And so I suppose with those conditions, when you look at market pricing of the forward interest rate curve, I think it's challenging to reconcile some of the market views with our pretty clear rate forward guidance. And I think various governing council members have been indicating, look, this issue, the market has not fully absorbed our rate forward guidance. Now, of course, it could be a different reading of the data. So the markets is aggregated across all sorts of different views, but in terms of expectation, in terms of most likely outcome, it's hard to make that reconciliation. And then maybe the other point I'll make, which connects to all of this, is throughout our strategy was to re-emphasize the way we think about price stability is with a medium-term orientation. It is not trying to kind of respond on a day-by-day basis. It recognizes that you can have fluctuations in either direction. And this is, as Patricia indicated, our kind of symmetric emphasis. It's important to recognize overshoots and undershoots, so long as they're transitory, do not require the same monetary policy response as a more permanent risk to price stability. So in the interest of allowing more time for back and forth and discussion, let me stop there, Thomas.
Thank you, Philip. Well, Andy, you started by mentioning that when you looked at the Fed Listens events, it looked like Fed listens to itself. But when Philip described the sister approach that the Eurosystem took after the Fed review, it sounded like we listened, or maybe the Fed and the ECB listened to Fed, but we heard it. I refer to the views expressed by former Fed members Bernanke, Yellen, David Reifner, and even the president of the New York Fed, John Williams, who were not promoting averaging inflation targeting, but asymmetric averaging, which is like Philip was calling it, it's a conditioned on having been hit the zero lower bound or effective lower bound. So and to me it sounded like your problems with AIT was mostly that it is symmetric. Did I got it right? And on Patricia, you mentioned that the approach could probably have been different if it had been taken with this economic and price outlook that we have currently. I think that in Japan and in also perhaps in Eurosystem we are probably enjoying the price shock because it takes us to the target, not away from the target. So just basically to Andy and Patricia, you mostly, how would you compare the Fed strategy review with the Eurosystem one, which you perfectly know well and Philip was just describing?
Patricia, do you want to start this time?
Yeah. So I'll start. So, well, to state the obvious, the ECB did have a ceiling, and they've decided not to do that, which I think is incredibly wise, particularly in the face of the sorts of supply shocks. Frankly, the U.S. has the luxury of being insulated from a lot of smaller supply shocks. It's a lot harder to get when you're the currency that a lot of the commodities are based in. You don't have the kind of terms of trade shock that the Eurosystem and everybody else in the world does. And so when the U.S. faces supply shocks, they tend to be big and they're infrequent. And I think it's one of the reasons that perhaps it is even trickier because it's for the Fed, because it than for the ECB, because they have not had a huge number of large supply shocks that they've had to deal with. And a lot of the models and the structure of the thinking of the committee members, the reaction functions that you can estimate for how the Fed's going to react to things not very much of that history is included in those. And certainly the last time we had supply shocks like this, the Fed was definitely not inflation targeting. So that's sort of my main set of observations. I think otherwise the idea that central banks are being much more explicit about what they are going to do when inflation is too high, as well as what they're going to do when it's too low. The obsession for the last 20 years has been what's going to, keeping inflation down here. And if you can get yourself to target and above target when you haven't been there for a while, and you're pretty sure it's transitory, sounds right to me, particularly when the economy's weak, and it actually helps you out. Your short-term interest rates look even more negative, which hopefully helps you with both the supply shocks and to adjust to both the supply shocks and the demand shocks.
So I guess I want to just revisit. I mean, Trish was saying she was talking about the lack of consensus on strategy, and so it's very ironic, right? Because the document that the FOMC issues, the Federal Reserve's Monetary Policy Committee, it's called the Statement of Longer Run Goals and Strategy. So the problem with that document is that actually in the new framework, the goals became more fuzzy and the strategy was almost eliminated. But it used to be that they had a very clear medium run goal of hitting the inflation target. Now it's this average inflation target where there isn't any clear definition of what the horizon is that is going to be used to determine it or assess it. And on the employment, they used to be looking at what they called the longer run normal or the longer run sustainable level of unemployment, and the idea of shortfalls of employment relative to full employment was gauged in terms of that. In the new framework, they no longer quantify what the employment shortfalls are. And in terms of the strategy, they used to have a sentence saying the committee's committed to following a balanced approach, which people understood as meaning, placing roughly similar weight on these two objectives in the dual mandate. They decided to remove that phrase. So now it's completely open-ended. It simply says, well, we'll look at the shortfalls of employment and we'll look at the deviations of inflation and we'll just decide. But I think when they adopted this framework in summer of 2020, it was in a context where they didn't expect to lift off for almost 5 years. The projections at that time was lift off in 2024. So they were kind of figuring, well, we'll work this out as we're getting into the next framework renewal, we can kind of figure out what we're going to do after we lift off. And it seemed like it would be fine. Unfortunately for the Fed, I think fortunately for the economy, the improvement in the employment and the increase in inflation happened much, much more rapidly than we've ever seen before in the US economy, literally faster than ever. And so those decisions that seemed like they were 4 or 5 years away now might be 6 months away, that they're going to have to decide maybe by next spring and summer, not just when to lift off, but how quickly to raise rates. And so the lack of a strategy, lack of an agreement is going to become very painful. Probably with high probability, it's going to be very difficult within the next few months.
Can I do a very short two-hander in response to that? I want to agree completely with Andy, and I want to add that what's interesting about this is that weirdly enough, in the current circumstances, the new framework has actually helped to clarify over the very short run what the FOMC is going to do. I mean, you can have the chair stand up at a press conference saying basically how quickly we do this, meaning taper, how quickly we do the taper completely depends upon employment. Inflation's where it's got to be. It's going to come down. Don't worry, whatever. Sorry, I'm exaggerating, but my point is that it really is completely about how the job market evolves. So my view of that is that actually if we have a big negative macro shock in the next 9 months, the only risk to the taper expectations that are there now is that they might actually have to pause. But that would be because economic conditions deteriorate, not the opposite. But anything further out into the forecast, it throws into greater uncertainty, and not just on the part of the markets and business people and households, but as I suggested in looking at the SEP numbers, amongst the committee members themselves.
Philip.
Well, I mean, I think, again, going back to the basic role of these strategies, I think Andy earlier on said it's this issue about certainty, certainty about, how does the reaction function work? I mean, again, in the context of the ECB, let me emphasize, I think it's so important that we have got a strategy in place now. Because imagine the uncertainty that we would have now, I think, about monetary policy, about interest rates, in the absence of what I think is very clear set of criteria in terms of our rate forward guidance. It's also, I think, very clear, I should say, in our strategy, is that we emphasize that our additional tools, asset purchases, forward guidance, long-term refinancing operations, are there to help us deliver the 2% target. So if you like, we've normalized those instruments that when the lower bound presents a constraint so that the set of policy rates are not enough, we will actively use these instruments as we are doing right now. And that provides, again, more certainty. Why are we buying assets? We're buying assets in pursuit of the 2% medium-term inflation target. And it's very important that we're very clear, especially in the complicated euro area setup, that our kind of straightforward mandate and our kind of very much target-orientated approach is very important. Again, maybe I'll come back to something Andy said earlier on. I mean, for us, we're also crystal clear with this review that we take the treaty as given. I mean, there could be a different conversation, a different debate could be had in other settings about the European Treaty, but this is not for us. I mean, for us as appointed central bank officials, our focus is just on delivering what we're required to deliver, which is this focus on price stability. And maybe just in passing, very much my view, and it's, you know, I think well covered in the 18 occasional papers we put out a couple of weeks ago, that essentially our medium-term orientation very much allows us to take into account these type of cost push shocks, and especially, essentially, it gives us the flexibility to absolutely put a weight on employment. That, you know, by and large, in many circumstances, there's a divine coincidence. What's good for price stability is also good for maximum employment. But where there is a trade-off, rather than be, if you like, kind of excessively focusing on the short-term inflation profile, our medium-term orientation gives us the flexibility to put a kind of significant weight on other considerations.
Thanks, Philip. Somehow I get the feeling that even though the strategy reviews on both sides of the Atlantic resulted in somehow similar result, we are fighting with a different war with our strategies currently. So whereas it seems that the debate is heated on inflation in the US, we are still suffering from the too low inflation here, and maybe the US strategy review was better suited for our case. I would like to raise something that came to my mind from Patricia's intervention. Well, normally, and in these reviews, we tend to think and say that we need transparency and openness and explicitness in doing the monetary policy. We need to be clearer with our reaction function. We need to give more information so that people know what our target is and how we behave. Andy was calling more info, for example, on how long and how much the Fed tolerates inflation beyond 2%. But on the other hand, can the information we give sometimes be too much? For example, I'm not sure whether the Fed dot plot currently reduce uncertainty, as Patricia was saying. It could be the opposite, and then one wonders whether it's counterproductive to whether it can be the case that one could be giving too much information, and this same could be if one was very explicit on the inflation deviations and trying to quantify the employment targets, and especially if you try to achieve them simultaneously. I'm not sure. Could it be the case that sometimes it would not reduce, but even exacerbate uncertainty. Any views on communication and uncertainty?
So my father was a physician, so I oftentimes think in terms of medical analogies. So if we just imagine we were having this discussion at a medical school, you know, the question of how much to explain to the patient and the patient's family, and in a situation actually where the patient could in fact be a child or a teenager, you have to be careful, you know, what you describe. But if the patient's aunt or mother is a scientist, you know, or a distinguished researcher, then of course you would provide many more details to that person. So I think part of the answer to your question is when central banks are communicating to the public and to elected officials, just to be aware that there are different audiences. And some audiences want a fairly simple, clear message that doesn't take a lot of time and effort to digest. And other audiences want a lot more detail. I think the basic idea of transparency is not just to dump out endless amounts of information, it's to actually try to have real human communication. And again, recognizing what does the audience want to know, what do they need to know. I would say very strongly that central banks should never say, no, we're not telling you, because that creates a kind of a appearance of we're trying to hide something. The central bank works for the public. It's accountable to elected officials. The central bank should try to be as open as possible. Now, the other thing, just to come back to what I said at the beginning, there's a danger of groupthink, of insularity. And part of how you address that is to have diverse people making the decisions, diverse people on the staff doing the analysis that's brought to the decision makers. So I think a good model for this actually is the US Supreme Court. Nothing's ever perfect, but I think the US Supreme Court does a pretty good job. So what they do is they have a majority opinion. The decision that's actually going to be made, that's the change in the law or the reading of the law. But then there can be concurring opinions, which are justices who broadly agree with that decision, but their reasoning is somewhat different and they want to highlight it. And then there can be dissenting opinions. Someone who says, I just think that's the wrong decision. And sometimes the dissenters vindicated later. It turns out they were right. Sometimes that takes years or decades for it to happen. So if we think about central bank communications, you're right, the dot plot is not very helpful. It's only about a modal outlook. It doesn't clarify the reasoning behind people's different dots. The Federal Reserve and other central banks can do better here by trying to clarify a strategy and then having contingency plans for alternative risks.
Patricia,
yes. All I want to say is yes. I agree completely. It's tricky because, and let me reinforce Andy's point about how tricky this is for your different audiences. You need to have something that gives a sense of the risks and a sense of the committee and crudely the differences of views. But a huge amount of the audience for whom monetary policy should be really important and they should be paying attention to what the central bank does, I think they find it either too complicated to follow or there's sometimes too much technical information. Now, all the technical experts, including everybody on this in this workshop, fits into that latter category. But I agree that figuring out a way to communicate more clearly with everybody else seems about the strategy and the risks seems very important. It's one of the reasons I highlighted the point about weirdly enough, in the current circumstances, the Fed's new framework has actually made communication about tapering and probably the first rate increase simpler. But it's made the out years, right? When you'd really like to have a sense of where we're going to be in a year and a half, not where we're going to be in the next 6 months. It's actually made that harder.
Really?
So there's two issues here. One is about how to present risk, and the other issues about communication. And again, in our review, we spent a lot of time and we actually pretty quickly implemented changes to our communication. So in addition to the fact that the monetary policy statement, what used to be called the introductory statement, is shorter and there's a big effort to write it more clearly, in the end, I mean, we still have to have a lot of nuance in that. We have to have a lot of nuance in that statement. But we're also reinforcing that with animations, with kind of tweets, other things which basically convey to most people the bottom line. Now, when we come to risk, I mean, there's several different elements to this. One is we do have to find ways, always report both to the technical audience more generally, that we know, life can take many paths. But then when we think about, well, but I think it's also important to be clear about, our conditional best guess. Because if we say, well, who knows? I mean, all sorts of possibilities are there, and we'll throw out the information, but we're not going to give you our considered collective weighed judgment. I think it's important. I mean, this is what we do. Our professional lives are of the hundreds of people in the Euro system are there to try and filter everything. No one else has resources to do it. So it's very important for us to anchor our presentation about, we do think it's most likely that what we're seeing is transitory. We do think it remains the case that medium-term inflation pressures are below our target, not above. So it's important to be clear about our main narrative while also recognizing the risk. And then it's very important, and this is probably a big difference between us and some other currency areas right now, including the US, there's a very big difference between risks to the outlook versus risks to the target. So, inflation is unexpectedly high. And now stand aside from the transitory element. What's also true is that the uptick, say, in inflation expectations are just bringing us from below towards 2%. It is, if I saw a lot of information saying there's a lot of probability mass on, inflation outcomes persistently being well north of 2, which of course is an issue elsewhere, then it's a different situation. But right now, when people say, well, inflation's unexpectedly increased, in terms of the medium-term component, it remains the case that, it really is, to the extent there is improving five-year swaps, other information about the medium term, it's from below. It is not, a threat to the upside. So I think even just listening to me now, I'm pretty sure, okay, it's hard work even to process all of that. With the basic distinction between risks to our objective of 2% versus risks to our outlook, where again, the end of horizon inflation forecast is 1.5. Those are very different concepts. So let me hand back to you, Thomas.
Thank you, Philip. And if I get it right, none of us is eager to go back to the early 90s when one had to guess what the Fed funds target rate is, even for that. So that's great. And you were calling for scenario type of analysis or stress tests or tail event thing in central banking. I think certainly that helps thinking of monetary policy, but I guess the central banks are still conducting the monetary policy and will be conducting the monetary policy on the baseline forecast. So what do you think on still continuing on being explicit? Should we communicate these scenario analysis type, or should we mainly focus on in communication on the baseline and justifying what the current actions are? Or do you see any?
Yeah, but so first of all, I just want to applaud what Philip said about the efforts they've made to improve the communications. I think Hong Kong who's a hero in all of this. You know, his famous saying was, "Communication's a work in progress. It's never done." You know, so in a world where social media and all these things are, you know, constantly changing, you know, finding better ways to communicate to the public. I'm going to try to share my screen with you here for a moment. I think I can. Let's see if it works. Can you see this? This is a Microsoft Word document.
Yes.
And this is the comparison between the FOMC statement that it issued in mid-September compared to the one that it issued 6 weeks earlier in July. And the changes are showed with Microsoft Word track changes. And what you notice is, for example, they were saying inflation's risen, and they changed it to inflation's elevated. So, you know, so are we back to the normal view? I was trying to stop sharing the screen. Let's see if I succeeded.
Yeah, now it's quit.
No.
Okay, so it's back to normal. Okay, good. I'm trying new technology here. Actually, I think that, again, it's been unfortunate the FOMC in some way has become more opaque over the last couple of years, that these statements have become almost frozen with very few changes. We used to laugh about Chairman Alan Greenspan in the 90s because he would bury a nugget in the middle of a 2-hour speech, and people would have to look through it to find it. Here, you know, trying to find the difference between has risen and elevated is something Fed watchers are highly trained to do, but it's not really communicating to a very broad audience. So again, room for improvement there. I guess to answer your earlier question, I think, again, using analogies from physicians and meteorologists, they routinely talk about risks. So when the physician's talking to a patient, the patient's family, to explain, here's our current prognosis, here's what we know, here's the treatment plan. But the patient says, well, what if that doesn't work? And the doctor says, look, you're absolutely right. There still are some risks here, but we're monitoring these things closely. And here's our backup plan. Here's the next thing that we would do if it looks like this isn't enough. Okay, and the patient goes home and they sleep well, they relax, and they actually have a faster recovery. If the patient's confused or scared because they don't feel like the doctor is completely explaining everything and they're worried that there's some risk the doctor's not telling them about, then the patient doesn't sleep, they don't eat, their situation gets worse. And so there's a close analogy here. Central banks trying to patiently explain to the public not just a baseline outlook and a baseline plan, but there's material risks. And don't worry, we have contingency plans that we're prepared. And of course, we need to fine tune depending on the exact situation, but you can relax and be comfortable. And that's an ideal situation for the economy. I think, again, as Tricia said, we want to try to alleviate, the extent possible, alleviate the uncertainty that's unnecessary.
So I should have on my other screen questions put up to the chat, but it seems to have been frozen. So Esa, if you see questions in the chat from the audience, please feel free to step in and interrupt us. Otherwise, I would still want to have your views on some other aspects that were or were not discussed in the strategy reviews. Do you have any views, for example, how the monetary and fiscal policy interactions were treated in the reviews, Patricia?
So I think central banks have quite carefully and rightly stayed away from talking too explicitly about fiscal policy. Not smart, not possible in the euro area anyway, frankly, because there's too much diversity and differences across the different countries. And in the US, just plain not wise. I do think that central banks do need to take into account and at some point acknowledge the fact that fiscal policy as a countercyclical policy tool is back. It was not basically hadn't been used for, my heavens, in the United States a couple of decades anyway. But during the global financial crisis, it was used, and it was used to unbelievable size. I mean, we're talking wartime finance sort of size in the United States in both 2020 and 2021. And it was wildly successful, but as I mentioned at the beginning, it is been one of the contributors to the fact that there are such supply problems, because excess demand in the United States has been off the charts for the last 9 months or so. So I think what the adjustment that central banks need to make in thinking through their frameworks, and I don't know how much they want to talk about this, but the next time perhaps that the frameworks are rethought, is to consider the relative roles of different types of countercyclical policies. It's assumed that monetary policy is going to try to be countercyclical, right? But the last two large recessions, it has not been completely the only game in town. And the only question is, what's the role of that fiscal policy? And more importantly, how a reminder of just how incredibly powerful it can be, and what degree the central bank doesn't always have to coordinate with fiscal authorities. They did during the pandemic, but that's a very special case, it seems to me. But to what degree they want to explicitly talk about the way that they are taking fiscal policy into consideration in formulating their monetary policy views. Particularly in the US, the Fed has done a little of that, but they, it's really not part of the basic framework, but it's worth thinking through, because I don't think using fiscal policy in a countercyclical way is going to go away. As a matter of fact, I kind of think the legislatures and the fiscal authorities are sort of empowered by how powerful it's been, particularly in the last couple of years.
And anything to add?
Well, I guess my worry looking ahead is when we started the 2007, 2008, 2009 financial crisis, the US was in pretty good fiscal shape. And there was a view that we had lots of fiscal space to provide stimulus. And maybe that the fiscal stimulus wasn't even big enough given the circumstances at the time. It probably wasn't, didn't occur over a long enough time period. I think there was initial expectation that the crisis would be resolved and the economy would get back to normal quickly, and that didn't happen. Now we're faced with a situation where the US budget deficit, the total debt outstanding held by the public, is close to where it was at the end of World War II as a percentage of GDP. And so now if we had another severe shock in the next few years, and hopefully we won't, but we could, and we had another 20 or 30% increase in the debt to GDP ratio, along with a structural deficit that's associated with demographic factors that are already were pretty significant. I still, Trish, I guess I'm uneasy that if we look ahead 5, 10, 15 years, that even the United States could be in a situation like some European countries were in 10 years ago, where there's a feeling like we're pushing the limits on how far we can go, and that the fiscal stimulus could be hopefully still helpful, but constrained. And in that situation, it seems even more critical for the central bank to be prepared to take on more of the role, not to be the only game in town, but to take on more of the role. And so, again, these are that's the contingency plans, not just for the next year or two. The contingency plan that should be happening is thinking far ahead, 5-year, 10-year. And again, in the context of a framework renewal, hopefully a mixture of some of the things of what is the most urgent issues, but also some discussions with the public, with elected officials, with other experts, what kind of longer, like climate change came up in the previous session, these are issues that central banks absolutely should be thinking carefully about.
Yeah. So I don't disagree with that at all. Exorbitant privilege only gets you so it gets you a long way, particularly for the United States. But since everybody likes to buy your debt, but we know there's a limit to that. The U.S. actually had a problem in the late 80s in this department, and it ended up raising taxes. And the first President Bush lost the election in part because of that, because all of a sudden international investors got nervous. So I agree with Andy about that risk. But I also thinking for the next year or two, the first thing that's going to happen is actually massive fiscal contraction. And so every time I hear someone, it's already started in the US, every time I hear the central bank, or when I hear, usually it's financial people in financial markets who are talking about how dovish the FOMC's rate forecast is relative to perhaps what the markets expect. And my reaction to that is, well, yeah, because I would be nervous about the extent of fiscal contraction that's going to happen over the course of the next 12 months. Literally, government spending is going to fall by at least $1.5 trillion in 12 months in the United States. It's a very, very large change. And the question is, what is that going to do, both on the inflation side, obviously, on the income side, and into the labor markets? I don't have a good answer to that. But I think it's a really significant, interesting risk and uncertainty.
Yeah, you never know what is going to happen on that front. I remember some 15, 20 years ago, you had a dossier at the Fed in New York on thinking how to implement monetary policy in a country without public debt. Well, it didn't happen. Yes. But I'll give the final word of the panel to Philip on completing on this topic.
So on fiscal, I mean, our focus was on our job as opposed to the job of the fiscal authorities. So our strategy statement, our two-pager, is focused on us. But what is true is we had a parallel, longer analytical overview note where we did basically point out, of course, a more counter-cyclical fiscal policy, especially near the lower bound, would basically create more monetary space. It would relieve the kind of pressures of low inflation and the lower bound constraint. But while always combining that with debt sustainability. Now, of course, for us, we focus on the aggregate euro area, even if of course, in turn, apart from Next Generation EU, the whole overlay of fiscal frameworks at the national level. So the mapping from our kind of area-wide macro perspective to recommendations for national fiscal policy, this is left to the European Commission. But I would mention also, when you look forward to the next couple of years, now the budgets for next year are being written in Europe. And there is probably a distinction between the rolling off of kind of emergency pandemic supports, which has been the main source of large deficits in Europe, as the economy recovers, to be automatic improvement in tax revenues. So we don't have the level of Biden stimulus in the US. But that transition, the transition from 2020, 2021 scale of fiscal intervention in the economy, there is going to be an interesting handover that, the private sector should be recovering at the same time as the public sector is pulling back. But of course, any kind of transition, whether is, of course, subject to risk. But this will be a pretty major issue because, of course, the fact that we've had a good recovery is bound up in a really large amount of fiscal support, a lot of which has been taken in the form of transfers to households and different types of transfers and subsidies to corporates. And then you have that balance sheet issue of, okay, you've got a lot of accumulated savings and so on. So the pandemic is unique in that respect, but it does mean there's a multi-year knock-on effect from the big fiscal interventions of the last couple of years. And so let's see what happens in the years to come.
Thanks, Philip. And one of the lessons from the strategy review was that they are, at least in the Eurozone, they will be periodic. So I hope that we can repeat this discussion in 5 years' time after we've gone through cyber virus or something like that. Another black swan that we
Please
don't yet know, but well, hopefully not. But I'm responsible for IT in the Bank of Finland, so I'm hearing constantly on that as well. So thank you all, Andy, Patricia, Philip, for making up this great panel, and this brings us to the end of the whole 7 hours long SUERF Bank of Finland seminar. I would like to thank you all, as well as the viewers.
Thank you.
Thank you all.
Thank you, and see you. Bye. Hopefully physically also.
Okay.
Thank you very much.